EPC, and the topic engineering, procurement, and construction companies. And these companies are facing some stress. And the stressed EPC companies, they represent a very unique asset class, and that is why we thought of focusing on this very, in a very specific segment today, rather than talking about, generic. We've been doing a lot of stuff on the debt assets, but this time we tried focusing on sector. And very grateful to the Chief Economic Advisor and Chairman IBBI to join us this morning to talk about this very important segment of the economy. And government, of course, has done a lot in the recent past to really give vigor to the infrastructure sector. And I think a few more nuts and bolts here and there. And I think we are all set to kind of have a walk on the growth path desired by everybody if infrastructure kind of falls in the place that everyone desires it to be. May I now invite Mr. Rashesh Shah, the past president FICCI, for the welcome remarks, please. So you're on mute.
Okay. Thank you, Jyoti, and a very good morning to all of you. It's a great honor to be here, and I think talking about infrastructure, talking about distressed asset is always, always exciting because there's so much happening all the time. So though we have these conferences often, there is always a lot of new things that have happened in infrastructure as well as in distressed assets. So I'm very happy that we have this conference today and all of us with this esteemed audience have got together. On behalf of FICCI, I want to extend a warm welcome to all of you and thank the Chief Economic Advisor, Dr. Subramaniam, and the Chairman IBBI, Dr. Sahu, for being with us and gracing this occasion, because I think your insights, your views on this topic will be very, very interesting, and we all look forward to hearing your perspective. I think all of it goes without saying that infrastructure is the biggest opportunity and challenge in India as we go forward. And even when we talk about distressed asset, I think infrastructure has been one area where a lot of changes have happened in the last 10 years. And one of the biggest issues with infrastructure investment in India has been the availability of long-term, flexible and patient capital in India. And one of the ironies in India we have a lot of savings. India saves almost more than 30% of our GDP, which should be now close to $1 trillion of saving. On a $3 trillion GDP, we might have close to $1 trillion of savings. So this is a lot of money, but converting these savings into investments has been the biggest issue. And whether via banks, via mutual fund, via bond market, via insurance companies, India has been grappling with this challenge of how to divert more long-term capital, which is flexible, which is patient, which is, really has some risk characteristics on that, because this is what infrastructure needs. And a lot of experiments have been tried. The new one of the government setting up a development finance institution is also going to go a long way towards enhancing this capability of converting our savings into long-term investments into India. In the past, a lot of challenges in this have been that infrastructure has had two parts. I think, one is the EPC companies, as earlier Jyoti was saying, and the other are the infrastructure assets. And what we have seen is in infrastructure assets, once the assets are developed, once they are up and running, they are actually very attractive, and we're seeing a lot of capital. We ourselves in Edelweiss have brought a lot of capital to buy out and monetize these assets. So an asset which is up and running has actually characteristics of attracting a lot of capital, because now the risk has come down, now the cash flows have become more certain. But while the asset is under development is where the risk is the highest, and the capital available for that has been a big challenge. A lot of the distressed assets in India are in that category, projects which are not yet completed for various reasons. I think some internal, some external, but there have been a lot of reason where infrastructure projects have not yet been completed, because once they are completed, there is a huge interest from investors into that. And we are seeing that in roads, we're seeing that in renewable energy, we're seeing that in transmission lines, we're seeing that in almost every category, including real estate. Commercial assets, REITs and InvITs have been very popular now. So I think the key challenge is how do we complete those assets, the ones which are incomplete, and how do we provide the right kind of funding while the projects are under the execution stage, under the development stage. I call them caterpillars and butterflies. When a project is under development, it is like a caterpillar, and once it is developed, it is like a butterfly. There is a lot of capital for the butterflies. We need to arrange capital for the caterpillars also, because that is also where the largest amount of distress in infrastructure assets have happened. The other challenge on infrastructure are the EPC companies, because they are not the asset owners, but they are the ones who develop the asset. And they also carry a lot of risk because they don't have assets on their balance sheet, but they take a lot of execution risk. They have a lot of working capital requirement. They also take a lot of counterparty risk, because if the project gets stuck and they don't get paid, then a lot of EPC companies have also fallen under stress and have gone into the bankruptcy code. So the infrastructure, both the parts we have seen, the EPC companies, how to make them healthy, because even the current stressed assets in the EPC sector, there are no assets to sell. So anyway, recoveries are not an easy option or not a viable option. A lot of these EPC companies have a lot of capabilities, a lot of receivables. They have a lot of assets under arbitration. They have a lot of cash flows that could come to them in the future. So one of the challenges we all grappled with is how do we revive this EPC companies? How do we make sure that even after revival, they have the right kind of working capital available to them? Because if there are no EPC companies, who will develop the infrastructure in India? So I think one challenge, and in our ARC also, we have worked with a few EPC companies which have which have become NPAs and stressed assets, and we have try to grapple with how to provide them a little bit more working capital, how to help them get their arbitration awards. And I think the recent actions by the government in expediting arbitration awards and all. And arbitration award is not only the problem at the center, a lot of this is at the state level also. A lot of infrastructure projects which have had cost overruns and time overruns, they also need to get compensated, and there are a lot of arbitrations going on. So as that comes in, the EPC companies can get revived, because a lot of their account receivables can come back. In fact, for an EPC company which has become distressed, the biggest asset are receivables, whether client receivables or arbitration receivables. Those are the only real assets they have. But using them and reviving them is very important, because if we want to create our $100 trillion of infrastructure assets in the next few years. So I hope that today that aspect of how to have the right kind of EPC companies, how to make sure they have the right balance sheet, they have the right liquidity and capital, working capital availability for them, for both distress and after they get restructured for their ongoing viability. And the other part of infrastructure are the infrastructure assets. How can they be completed, how they can be made productive, how can we generate cash flow from them, and then eventually release capital that is embedded in that via InvITs and REITs and a lot of infrastructure debt funds which are there. So we've seen a lot of innovation in India in the last 5 years. I think amongst all the problems that we have seen in India in the financial sector in the last 5 years, the NPA, the liquidity crisis, there has been a lot of positive development. And I would say the development of InvITs and REITs and infrastructure debt funds have been one of the biggest achievements we have had. We have not yet spoken enough about it. So I do hope that today we get a chance to even underscore that the development of infrastructure debt funds, in which REITs has been a big new source of capital available for the infrastructure sector. And obviously, in the last 5 years, when we talk about development, we cannot not talk about IBC. So IBC is another big development where we can have real structured, resolution on asset which have fallen on stretched times. And we are seeing that more and more we are seeing companies are not stressed. The company business model is not stressed, but the balance sheet is stressed. The promoters are stressed. So the idea is that through capital infusion, through financial engineering, can we make the capital base stable? Can we repair the balance sheet and allow the underlying potential of the company, the productiveness of the company in the infrastructure sector to start generating value once again? So I think IBC and the other developments in capital markets creates a lot of opportunities for all of us. I think the new ideas that IBBI has been recommending, including out-of-court workouts and pre-packaged insolvency packages and all, are going to be a big advantage to that. And lastly, I would say a lot of infrastructure we think are large companies, but a lot of infrastructure and EPC companies are also MSMEs. They are contractors, they are subcontractors. A lot of those companies are also caught up in this insolvency process or distress process as a result of all the changes that have happened in the infrastructure sector in the last 7 to 8 years. So I do think there is a great opportunity, and we believe that this opportunity is not just recovering money for creditors, but it's creating value for all stakeholders via revival, via resolution. In fact, the slogan Sabka Saath, Sabka Vikas applies to this the most. I think we have to find ways of doing Sabka Saath, Sabka Vikas on these stressed assets where the creditors get their due, the company and the employees, have a potential to work and create value in the future. The operational creditors, the statutory creditors also get some recoveries out of that. So the idea is that as we embark on this, we have to focus on more and more revival rather than only recoveries. In fact, the expectation of IBC has always been the revival and not just recovery. It is recoveries via revival, not just recovery via asset sales. And I think that in infrastructure is very important. And the other is how to create a balanced outcome for all stakeholders so that we can actually find win-win-win for everybody in this, because the companies are not to be run only for the promoters. They are not only to be run only for the creditors, but they should be revived and run for creating value for the country as a whole. So along with that, I do hope we have some very interesting conversations today, very interesting discussions today. And as I said, we have Dr. Subramaniam, we have Dr. Sahu, great speakers, and then we have great panelists all through the day. So I do look forward to a very exciting conference today. Thank you very much for that, and thank you all for being here.
Thank you, Mr. Shah, for pointing out some of the opportunities in this space and how we can really make this more financially viable for the benefit of the economy. I now turn to the Chief Economic Advisor, Dr. Subramaniam, for his special address. We all know that he's been very supportive of the adoption of expansionary fiscal policy focused on infra financing, infra spending. So I think his views will be very useful and critical for this subject. So over to you, sir, for your special address, please.
Good morning, everyone, and thank you very much to FICCI and the organizers for inviting me to share my thoughts. It's indeed a pleasure to be talking on this extremely important topic. While, as Jyoti mentioned, clearly there is, of course, a significant need for India to focus on infrastructure spending and, counter-cyclicality of fiscal policy to aid infrastructure spending. I'm going to focus on a particular aspect relating to distress in infrastructure projects. Especially why one of the key reasons why distress happens in infrastructure, and also why distress prolongs in infrastructure overall. So all the stuff that Rasesh talked about, I think those are important. Financial engineering, these are areas that I have, before my PhD, I'd worked on. But I want to focus on what I think is really the elephant in the room, and I think which really needs to be focused on. If you look at overall since the 1990s, early 90s, The key problem that we have had in the banking sector in India is, that key problem is about the quality of lending, especially on large loans. And I'll use these exact words that I'm actually going to be talking about: crony lending. I think that is in general a problem in the banking sector. Because if you look at the non-performing assets, and both in the last year's economic survey, the chapter on 50 years of bank nationalization, and this year on the chapter on regulatory forbearance, we've shown very clearly how the banking sector problems have actually stemmed from large loans, which are not necessarily lent to the most credit-worthy borrowers. And I think this is a generic problem, but actually this problem gets far more exacerbated in the context of infrastructure. And the financial institutions especially need to be working on this aspect. Why is it the case that infrastructure faces this far more? Because by definition, infrastructure involves regulatory permissions, and there's land to be acquired, environmental clearances to be obtained, and so there are interactions with agencies that then actually create the potential for greater crony lending possibly to happen. So I think this is the elephant in the room that we have to acknowledge, because one of the key jobs of a financial sector in a country is to actually do optimal capital allocation. How does the financial sector do optimal capital allocation? When faced with two projects, one which is really deserving, and another that's not as deserving, but possibly from a borrower that is far more connected. When the financial sector actually as a whole, and I want to talk about the financial sector as rather than focusing on specific entities, when the financial sector decides to actually lend to that particular borrower who, that is more connected, even though that borrower may not be the most credit worthy, what that means is that capital is not being provided. There's an opportunity cost. That capital does not go to a more credit-worthy borrower. I think this is extremely important that the financial sector in India actually takes responsibility for the fact that it is the ultimate arbiter of capital, and ensuring that optimal capital allocation happens in the economy. That is the job of the financial sector. We've pointed it out earlier in the last year's economic survey, how if you take the banking sector and the financial sector itself, it is so small compared to the size of the economy based on any parameter, and that's mainly because the financial sector as a whole is still to figure out the model to actually make large corporate loans, large infrastructure loans are a subset of that. In a way that does not lead to non-performing assets. And at its core, crony lending is actually the big problem. This is the elephant in the room that has to be spoken about, and I'm therefore choosing to talk about it, which all lenders and borrowers need to really be concerned about, because of the interaction, and this problem becomes far greater in the context of infrastructure. So that's in terms of the adverse selection problems that happens. So if economists think about two key problems in the context of lending: adverse selection and moral hazard. The adverse selection problem is about actually choosing to give a loan to a crony, especially in the context of infrastructure, rather than to a more credit-worthy borrower. This is something that the financial sector needs to really grapple with. And I think there can be any number of reasons that lenders can always point to environmental factors, bunch of other reasons. But I think what the leadership, if you think about, and I'm sure all of you are leaders, leaders never ever point fingers at others. Leaders take responsibility to actually get the job done themselves. They put that responsibility on themselves. And I think every financial institution now, given the aspirations that India has to actually become a really a $5 trillion economy, every lender, every financial institution has to take that leadership role to really not look at external factors. No, look internally and see what are the things that can be done to ensure that capital allocation in the economy, especially on infrastructure projects, is of high quality, and that we do not have this periodic bouts of accelerator brake. When the economy starts doing well, the lenders start lending as if there is no tomorrow, and the seeds for the next crisis are basically sown at that time, and then we actually have a crisis. Then we have to put clamp the brakes on lending, and this, as a result, the economy really suffers. I think the financial sector, especially in the context of infrastructure, with the focus that now capital expenditure, I think it is extremely critical now that the financial sector owns up this responsibility of doing high quality lending, especially on the infrastructure side, and really avoid crony lending like plague. I think that is basically, that has to be the mantra for the financial sector. Related to that, that's the first aspect of why we get so much more distress. Because if the quality of lending is actually much better, obviously, there are other factors, and I'm not denying there are exogenous factors, permission, sometimes, things change, uncertainty, and one is not discounting any of those other factors. But the point that I'm trying to make is, given what those are, can the lenders, can financial institutions look internally and say, what is beyond our control, we can't do that much about it. What is within our control? Can we actually focus on that? Boards, the senior management, can they look internally and say, what are the things that we can fix on our side, to ensure that this basically, lending is only of the highest quality? And here I think the development financial institutions, will play an important role. Why? Because infrastructure lending especially is one that requires very specialized expertise. I remember when I used to, before my PhD, when I used to work with ICICI, this was before it became a bank, there used to be teams that used to specialize in just road projects. There would be teams that would be specialization in, for instance, in airport projects. And that is indeed true, because, the operational aspects of a road project may be very different from that for actually ports, and that kind of expertise is something that banks do not have. And when you do not have that expertise, the ability to lending is far high. It's hard to distinguish between the high quality and the crony project when the expertise to distinguish is not there. Point to avoid. Second aspect, and this is even more important, and we've provided a ton of evidence on this in this year's economic survey, chapter on regulatory forbearance, because we're again in that period of forbearance. What we've seen is that once a loan goes into distress, there is this tendency to continue to evergreen the project, to continue zombie lending. And zombie lending, again, actually is both evergreening and zombie lending, then really block capital for good, credit-worthy borrowers, and instead keep putting good money after bad. This is something where, if at all, say the borrowers can the lender have to take complete responsibility that this is the governance where the board need to own up, The management needs to actually, to own up. Possibly incentive mechanisms need to be put in place by boards, so that, if there is crony lending, or if there is zombie lending and evergreening that is identified, that the compensation of senior management must be clawed back. There must be clawback provisions, so that because infrastructure projects especially are very long duration, and the quality of that, and if evergreening has been done or zombie lending has been done, comes to fruition only after a lag. Therefore, incentive compensation, to senior management have to have, clawback provisions, or this is something that boards must be thinking about, so that the incentives of senior management is aligned in such a way, and boards cannot be asleep at the wheel especially on zombie lending and on evergreening. These are extremely important aspects. Auditors are the first line of defense on this, and they need to really look at loan by loan and identify if there is, I think there is, now there is enough research, some of which we've covered in the economic survey itself, of ways to identify zombie lending, ways to point out evergreening. So I think auditors cannot say that this is something that we cannot use, and data can really be used. Analytics data can be used to identify this. So zombie lending and evergreening, that is something that has to be avoided, because that just ends up really leading to suboptimal capital allocation. So I think overall what I would emphasize, and this is based on almost the financial sector has been an area of research for me, especially the combination of governance in the financial sector. So this is the time, I think, when the financial sector has to really ramp up on its governance, because finally things like zombie lending and evergreening are related to governance, and it is up to the individual lender, individual financial institution to own up this responsibility and focus on governance, so that the macro emphasis that the country is now placing on growth through growth through capex, growth through infrastructure, happens actually in a sustained manner. The onerous responsibility of ensuring that this vision of infrastructure driven growth is indeed delivered actually rests on the financial sector. Please do realize your responsibility to the country, and take leadership in doing this. Please do not list out a litany of things that need to be done by others. Of course, they will they'll do their part, but whatever is in your domain, in your boards, your auditors, the management, take ownership, and if each one of the lenders can do this, can take that leadership, there is no reason why the quality of lending cannot be superlative in India. There's absolutely no paucity of talent, but oftentimes this talent actually ends up getting used in myopic ways rather than in visionary ways. And leadership is about actually doing possibly the hard thing, but right thing. And I think that is what leadership is all about doing the right thing. So I would humbly, very, very humbly request each one of you, each of the lenders, to take that leadership, that both the financial, moral and ethical leadership in ensuring that the quality of lending especially in infrastructure projects is high, so that distress does not happen. But even if distress happens, that that the right thing is done again, so that efforts to continue to evergreen or zombie lend are really avoided. I think if each one of the participants in this conference here, lenders, take that responsibility, I think the macro level lending will take care of itself. And I cannot emphasize this enough. I think eventually, for the macro economy and the macro goals to be satisfied, the financial sector plays a very, very critical role. I hope that these comments of mine will be taken in the right spirit. They need to be said, and that's why I've chosen this particular forum to humbly request all of you to take up that leadership role. Thank you very much. If there are questions, I'm happy to answer.
Thank you, Dr. Subramaniam. Your focus on the quality of lending and governance of boards and is a very strong message, and thanks for that, and thanks for joining us this morning. We move to Mr. Shailesh Pathak. Shailesh chairs the FICCI Transport Committee and has a 360-degree experience in infrastructure, finance, and execution, and with his government background and now in private sector, has a very rounded kind of experience. So it'll be great to hear your views as well, Shailesh, as an industry expert. Thank you.
Thank you, Jyoti. I'm very happy to be preceded by Rashesh as well as Dr. Subramaniam, both of whom have worked with ICICI. So that was my first job, 1986 to 1990. I'm in good company. But since you mentioned evergreening, we are talking about distressed debt. An American investment banker told me that a rolling loan gathers no loss. A rolling loan gathers no loss. And thank God that that phase is behind us now, that evergreening has stopped. Forbearance is much stricter now. Because as both Rashesh and Dr. Subramanian said, we are sitting in 2021, and it is definite that the next 10 years, we're going to see an unprecedented wave of infrastructure construction. But it appears that it's a cricket match that we are all set to play, but all the players are down with COVID. And the players here would be essentially the people who will construct the ideas in the national infrastructure pipeline into assets on the ground, which is the construction companies and the entire ecosystem. And it's not only the large companies like L&T, but it is also small MSMEs. It's the entire value chain. So if on behalf of the construction industry or the concessions industry, we had to suggest something to the financial sector, we would say that you should actually look at it in three ways. And this is also to the government. The first is assets that are completed, where no more construction is required, right? The second is where construction had started, but for whatever reason, the project does not get completed. It's incomplete. And the third is projects that are going to start construction. So just to keep this, and I really liked Rashesh's example of caterpillars turning into butterflies. To a large extent, you have ugly to look at construction projects full of risk, which are like caterpillars. And once it is an operating asset, it's lovely cash flows coming in, very pretty to look at. And one of the bigger myths that in India we have propagated is that an infrastructure project has a 30-year timeline, so it is very difficult to lend to it. Nonsense. The lenders or the finance providers, the capital providers during the construction phase are completely different from the capital providers during the operations phase. So the caterpillars attract a different set, the butterflies attract a different set. We in our company have 49% shareholding from a very large Canadian pension fund. And of course, 51% is from Larsen and Toubro. So we can see the difference in the construction appetite versus the operations and cash flow appetite. And to that extent, since InvITs were mentioned, our company had sponsored an infrastructure investment trust in May 2018 on a privately placed basis, where 92% of the entire units are held essentially by 3 global marquee players along with our company. So the operations phase is actually less of a challenge because there are lots of international dollars looking for long-term annuity type de-risked returns. So let's focus our attention on the first two. And before I go to the construction phase or the incomplete phase, let me also say that I completely agree with what Dr. Subramanian said about some banking practices. In fact, I am on record as having said that PPPs, public-private partnerships, turned into TTTs, which is taxpayer to tycoon transfer. Essentially, the tycoon borrows money, does not repay, and you and I taxpayers recapitalize the bank. And that is how TTT works. Again, thankfully, it is behind us. But we must also acknowledge that every PPP boom, every public-private partnership infrastructure boom is invariably linked with very, very cheap debt. And every boom inevitably ends in a bust. So globally, you had the Latin American PPP boom in the 80s and early 90s, which ended in a bust. In ASEAN, you had a major boom in the 90s, which ended with 1997. And I would say in India, we had a major PPP boom driven by cheap debt and some practices that Dr. Subramaniam referred to, which ended in a bust around 2012-13. So if you talk about construction projects, is banks financing the private sector to undertake construction projects necessarily the best way? Perhaps not. And to that extent, the recent economic survey and the recent union budget, I think, is a step in the right direction, where early stage risk under construction is going to be taken by the sovereign, the state, which actually has the best ability to handle risk. And once the caterpillar turns into a butterfly, then you will monetize that asset because there are lots of capital providers looking for such returns. So in many ways, it is the government rupee that will drive construction, and it is the international dollar that will refinance the government rupee so that the government rupee gets a much higher return and then redeploys that into fresh construction. So asset recycling and asset monetization are welcome steps. Coming to incomplete projects, or actually there is another category, and our company has developed more than 35, 40 concessions. So if all projections are good and the operating cash flow of the asset is more than adequate to service the bank debt, then life is very good. I'm happy to say that out of, let's say, 35, 32 are like that. Life is very good. Bankers are very happy. We are also happy. We are getting a return on investment. The problem happens when either the cash flow is insufficient to service the bank debt, or the problem happens when the concession is terminated and termination payments do not come from the authority. I can talk about broad examples. I won't go into specific names, but there is a particular project where we have to, as a company, infuse cash into the business on an ongoing basis so that bank debt can be serviced. And that we will do, because it is our obligation and our covenant that we signed with the banks to repay their dues. In this, how can the financial sector and the concessions and construction sector work together to enhance cash flows? And we have been able to do this with the active support of the banking system in one of our projects in a very large Western state, where we actually tweaked the toll plazas in the highway so that the net cost to the road user did not rise, but we captured the leakages in the system. And I'm happy to say that today it is a well-performing project. We got excellent support from the government there. We got very, very good support from the lenders there, and all of us are happy. Now let me give you a non-success story. In one of our projects, we could very clearly see, in fact, I should say assets, because projects convert into assets, caterpillars turn into butterflies. In one of our assets, we could very clearly see that while the annual debt servicing is, let us say, X, we could definitely hit 0.6x on cash flows alone. And the remaining 0.4x would not come out of the project, the asset cash flows. And in the spirit of non-recourse project finance, the lenders and we agreed into converting part of that loan 0.4x into equity. And then you had complete confidence that the 0.6x, which was the loan, was regularly serviced. So the banks were happy. However, since Dr. Sahu is also here, one of the banks in the consortium somehow said, no, we have to do something about it. So they went to NCLT and they said, because that 0.4x is not coming, it is a financial default. And the matter is pending in court for the last 2 years. This is not helping anyone, especially the bankers, because that 0.6x of cash flow, which was servicing their loan, is now stuck. It's in a moratorium because the moment NCLT proceedings start, no further cash will be given to the banks. So these are unintended consequences sometimes of actions by one bank out of a consortium of 12. So that's the second. The third category is when assets are not complete. So it's almost like making half a metro, right? How do you overcome the challenges of completing such assets? And that is where Rashesh's ARC for distressed assets comes in. We know a lot of assets that are 80% complete, 90% complete, but you have to connect that bridge to the other side before traffic starts flowing. Or you have to make sure that the balance of plant gets done so that the power starts generating. And that, I think, is a very exciting opportunity from a financial perspective, because for a limited investment, you are guaranteed a much higher return. And to that extent, the new breed of InvITs are not for this section, because InvITs are largely into cash flow generating assets and they have to distribute 90% of their accruals. But ARCs and special purpose funds might look at such assets in collaboration with companies like ours. Larsen & Toubro is a very large group. We are a very small part looking at concessions. But if we believe that in collaboration with an asset reconstruction company, we can complete a tunnel and suddenly cash flows start generating out of that tunnel, then it's well worth it, so that everyone makes adequate returns. Going back to this threefold categories of construction, incomplete assets, and completed assets. From a private sector perspective, knowing the international dollar interest, the constructed cash flow yielding assets do not require too much attention from governments, because that demand is there. Wherever there is supply, we as financial engineers and infrastructure companies will ensure that demand and supply matches. It is actually more to do with what assets are available in the government sector. And let me say that this is not only union government in Delhi or government of India. This is in every single state government. This is in every single city government. And if I could recommend something, I think the Government of India Ministry of Finance is talking about a 44,000 crore fund to reward the early finishers. Maybe this can be used to incentivize state governments and city governments to start monetizing their assets and go into this virtuous asset recycling. Coming to the distressed assets of banks, actually, the EPC companies are construction companies. They don't require large amounts of loans to finance assets. It is the concession companies like ourselves which require such loans. But let me spend a minute on EPC companies. So typically what happens is you have a contract awarded to a company in infrastructure. They get a mobilization advance and they get running bills on completion of every milestone. Now what had happened was that these billing schedules had been back-ended in the last few years, which meant that even if the EPC company has done 20% of the work, it will not get more than 5% of the cash. Thank God this has changed after COVID. The schedules have become far more fair. You don't expect EPC companies to behave like bankers or clients. They don't need to take money out of their pocket. It is the money from the client that is going to. The second is working capital debt. Now, working capital, all banks have relationships with EPC companies. But here the liquidity issue is much more challenging for EPC companies today, especially because a large number of government clients do not pay on time. Again, that has changed over the last 1 year because of COVID. And a large number of contract management issues do not get redressed well in time. So if there is a change of scope, that change of scope has to be sorted out in the next 3 months. If it takes 3 years, then the EPC company as well as the infrastructure project is in doldrums. And arbitration delays are hurting. I'm sure that the government is doing enough about arbitration, but we would obviously try to see a much quicker dispute resolution mechanism. Coming to the PPPs, the public-private partnerships, I would actually echo what Dr. Subramanian said, that unless the infrastructure sponsor has skin in the game, you cannot have a private public partnership with private investment, essentially bank debt plus whatever. And therefore, how can going forward we get over this challenge? I already talked about our specific issues on whether the cash flows are adequate to service the bank debt. I talked about there are cases, one of our projects where the government was supposed to give us land, it did not. So we terminated the project under the concession agreement. And under the concession agreement, termination payment is defined. And the government has to give 90% of the bank due within the next few weeks. Sadly, this has not happened for the last 3 years. And neither the banks are getting their dues, nor we are getting the termination payment so that we can satisfy the banks. So at some level, contract enforcement and speedy dispute resolution needs to be expedited. So moving a step forward, I know that people are now setting up practices to buy the distressed debt from companies like ours and go and litigate so that they can get that money and make a return. This is essentially not a sustainable model. But to conclude, I will just say we need quick dispute resolution. We need quick action by government as a client to make sure that they pay us, including in termination payment. And we need far more government money to the caterpillar stage, the construction stage, where presumably Government of India and others would focus their energies. For the asset monetization stage, especially in private sector assets, we are doing well. In the government, that is where a large bulk of assets is resident. And hopefully we will see monetization over the next 2 years. Thank you very much.
Thank you, Shailesh, for providing a lot of input into having a viable infrastructure project in various ways that we can, and also re-emphasizing, I think, some of the points related to governance and the knowledge about the entire segment that is required by the lender. I think you used the analogy given by Mr. Shah on caterpillar to butterfly very beautifully in kind of explaining all the scenarios. So we now move to Dr. Sahu. Dr. Sahu is Chairman IBBI. We all know him very, very well. And his presence always helps us in getting new ideas and new thoughts. And he's kind of enough in many ways. So may I request Dr. Sahu to kindly deliver the inaugural address, please?
Thank you, madam. Thanks to Vicky for giving me this opportunity. Let me start with some data. We know in case of a corporate insolvency resolution process under the code, today we have about 4,000 companies which have been admitted. Of them, about 2,000 have completed the process. About 350 of them have been resolved through resolution plans. So I am just trying to find out what are the characteristics of these 300 companies. These companies had on average the liquidation value of the assets, which was about 20–23% of the claim amount. On resolution, the creditors have recovered about 200% of the liquidation value. In these companies, creditors got about 45% of their claims, but about 190% of their liquidation value. And these companies on average had the assets liquidation value of which was about 22%. But there are companies which had assets 3%, 5%, companies having assets of 50%, but all of these could find a resolution plan. Now I'll give you 1–2 examples of EPC companies. Take the example of Jyoti Structures, which was one of the those 12 big accounts that has been resolved. That is a company where the liquidation value was about 12% of the claims of the creditors. This is the company where creditors got about, financial creditors got about 50% of their claims. Operational creditors got about 42% of their claims. But they realized in aggregate about 388% of the liquidation value. I told you in case of general all companies, the realization has been 200% of the liquidation value. This is one company, EPC company, where the realization is 4% of the 400% of the liquidation value. The companies which are getting resolved, some of them, as I told you, have very low assets. The companies which are getting resolved, so the companies which are getting resolved have, some of them have very low assets. We have seen that about 1/3 of such companies were either defunct or in BIFR. Despite that, there were people to submit the resolution plans. Let me give you one more example. MBL Infrastructures Limited, that's an EPC company where the liquidation value was only 270 crores. The realization by the creditors has been, the resolution value has been 675% of the liquidation value, where both operational creditors and financial creditors got their full dues. What I'm trying to say is that I fully recognize that EPC companies are unique. They are, as you have argued, they are asset light, have very little intangible assets. Value generally lies in largely dependent on their credentials, basis which it qualifies to bid for an infrastructure project. The ongoing projects of the EPC company which indicate potential for the future, etc. The expertise of the management of the EPC company. So EPC company in distress have some unique problems, but despite that, I gave you a few examples which have been very successfully resolved under the code, and which are even have the better outcomes as compared to other companies. So this is nothing very specific that EPC companies will have a difficulty in resolution under the IBC. Let me give also the facilitations. One order you may have seen yesterday that has come out from the Supreme Court in the matter of Gujarat Urja Vikas Limited versus Amit Cooks and others. This was the company, I think, most quoted company related to the Lanco infrastructure. So there was a PPA agreement between the Lanco and the Gujarat Urja Vikas Nigam Limited. So as the company went into CIRP and subsequently proceeded to liquidation, naturally the Gujarat Urja wanted to terminate the power purchase agreement. It gave notice if it wanted to terminate company. As company moved to liquidation, it also used the argument that in case of a liquidation, what is there for that company to retain the power purchase agreement, because the company will be liquidated in any case. The liquidator is liquidating the assets of the city, Therefore, the Gujarat Urja should not be forced to continue the contract for the benefit of Lanco or its liquidator. But the adjudicating authority, which in fact shows the tenacity of the resolution professionals, quite often the resolution professionals have been very instrumental and proactive in fighting to protect the value of the company. I think you know how many cases the matter has reached the adjudicating authority, NCLAT, and even the Supreme Court, where the resolution professional is somehow trying to protect the value of the company, but though those are permitted under the law. So this matter went to the adjudicating authority, set aside the termination notice and allowed the liquidator. In fact, as it had proceeded to liquidation, the secured creditor wanted to take away that power plant. So it went to NCLAT. NCLAT reiterated the views of the NCLT that assets need to be preserved during the resolution and liquidation process, so that the liabilities of the creditors and other stakeholders are taken care of. There is a waterfall and you can't disturb this even if the company is under liquidation. So the steady and assured return revenue stream that comes from that power purchase agreement, NCLAT told, is sine qua non for the long-term economic and financial viability of that solar power project. So NCLAT upheld the order of adjudicating authority, but matter went to Supreme Court, which Supreme Court decided yesterday. It's a very lengthy order, very detailed one, but I think that has a relevance for the EPC companies. What it did is that it told that this PPA is being terminated solely on the ground of insolvency. If it was not insolvent, there was no ground to terminate the PPA. So termination is not a ground independent of insolvency in this case. So therefore, Supreme Court told that the NCLAT and NCLT correctly stated the termination of the PPA by Gujarat Urja and allowing the termination of PPA would, as allowing it to terminate would certainly result in corporate death of the corporate debtor, because the PPA is the sole contract on which this power plant survives. It also made another important observation that the Gujarat Urja argued before the Supreme Court that this is something arising not because of insolvency proceedings, this is something else outside the insolvency proceeding. Therefore, the appropriate authority is not NCLT or LAT to decide the matter. So in this case, the Supreme Court held that this is a matter which is arising only on account of insolvency proceedings. And when such problems arise only on account of insolvency proceedings, NCLT will have a sole jurisdiction. I'm not getting into the section 60 of the bankruptcy code, but it is settled that if there is a dispute arising on account of the insolvency proceeding, that will be decided by NCLT. And in this case, NCLT and LAT have rightly upheld or prohibited state the termination of the PPA. I'm only trying to say that the facilitation, kind of facilitation one can do in the context of unique nature of EPC things. We know that the significant value of an EPC company lies in disputes like arbitration. And such receivables do not have a time frame for recovery. If the process results in the resolution, the corporate debtor would continue, and we can assume that the resolution applicant has factored in the underlying value of such disputed receivables. But such assets can be a serious impediment for a liquidation process. Keeping this in view, IBBI has recently allowed the sale of what we call through regulations not readily realizable assets. So if somebody wants to realize value from these not readily realizable assets like a pending arbitration, there can still be a transfer and some value can be realized and can be distributed under section 15 to section 53. Another issue has come up is that infrastructure and energy conglomerates generally, they are modeled around a holding company structure with several complex holdings across several project level SPVs. The maze of holdings has left most resolution professionals with the challenge to find the right value of the assets held. Therefore, the assets of the EPC company or holding company lie in the SPVs or the subsidiary company, and resolution of the group as a whole would apparently provide a more effective resolution. And Lanco Infratech is usually given as a case in point, but we have also other instances where group issues have come up, like in the video. So Lanco ultimately ended in an order of liquidation, and this liquidation is still ongoing. And slowly 10 companies, group subsidiaries have gone into also insolvency resolution process. And the absence of a group resolution framework is generally pointed out as one of the lacuna in the insolvency regime. But I think the people, the authorities are aware of these issues. And there is already some work has happened. There was a committee which has recommended a framework for group insolvency resolution. Another committee has also recommended, in case of international transactions, cross-border insolvency resolution. And someone of you mentioned that there are ways also to look at quick resolution through more of informal mechanism like the pre-pack. So all this, I think, would help every company in resolving this stress, and also the EPC companies. But we should remember that the EPC companies or any other company, we are in a market economy. And we believe that when market fails, state should intervene. The state may also fail. But we are dealing with a situation where market really succeeds. Market succeeds means some firms will fail either because of competition or innovation. And that is a good thing. We welcome. We think competition and innovation are extremely welcome because they promote economic growth. But we know that in the competition and innovation, some firms will not be able to do well, some will run behind, some will be pushed aside. So therefore, the state should enable some kind of a rescue mechanism, but not anyway inhibit the competition and innovation. So what I'm trying to say that in a market economy, a firm fails because the market succeeds. In fact, if the market is more efficient, the incidence of failure of firms is more. So failure is inherent in a market economy. Since the problem has arisen because of the market forces, one expects that, or one would like that, let the market find out its own solution, though it can be facilitated, state should facilitate. There are several frameworks from state, though not necessary. The stakeholders on their own, informally, bilaterally, can sit with one another, resolve the stress. But yet, state has quite a few frameworks like the scheme of arrangement under the Companies Act, the corporate insolvency resolution process under the IBC. There is something called Section 12A withdrawal under the IBC. The talk is on about the pre-packaged insolvency resolution process. We have prudential framework of the Reserve Bank of India. But please note that all these frameworks, formal frameworks, all of them are non-sectoral. IBC or scheme of arrangement or RBH prudential framework does not say that if you are in power sector, you will have one path. If you are in some other sector, you will have another path. The objective is that the state should keep competing options for resolution, and it is for the stakeholders to choose which one suits to their unique circumstances. Market economy is all about choice. As long as so many choices are available, the market should choose, the farm should choose on their own what helps them, but it may be difficult to provide a different dispensation within a framework depending on sector. There are certain things like the competition is a non-sectoral law. Insolvency is a non-sectoral law. We had earlier issues, say like somebody makes an initial public offer. Should there be a different IPO framework for companies in insurance sector or for companies in manufacturing sector? This debate continued for some time, but it got settled that it will be only one uniform pattern of IPO. So you cannot, because the logic is that the resources of the country or capital, whatever banks are giving, these are limited, and we want to put them to most efficient uses. If a particular framework, let's say CIRP, treats sector A on a different level playing field, then sector B, this actually causes market failure. This really impacts the resource allocation. That means if some industry is given a better protection as compared to others, or some creditors are given better protection than creditors in another sector, it can be either way, it can be creditor, debtor, or any stakeholder. Wherever you give preference or additional benefit to one sector, one participant there, people will behave differently. So for example, today EPC, we believe that these are very highly leveraged companies. Sometimes it goes to the 10:1 kind of ratio. So if you say that the creditors of EPC companies will not have the same protection as CIRP stroke IBC gives, or a differential CIRP framework where the protection for creditors is less, then probably creditors would not be that enthusiastic to lend to EPC companies. Therefore, the EPC companies will suffer more. That's why all along we have been talking that the government policies should be neutral across the sectors. The direct benefit transfer, GST, these are all examples of a neutral policy, but there should be competitive framework. There should be 5 frameworks for the market to choose. But within a framework, it may be difficult to give a preferential treatment to one kind of stakeholder or one kind of company. In any case, as we know, there are no compulsions to use any of these framework. IBC gives an enabling framework. It's a choice for the stakeholders. If they do not want to use, they're absolutely free. They may not use IBC, they may not use Prudential, they can do everything outside the framework. But these are the frameworks which generally give a guided path for people to conclude the transaction. But entirely it is their choice. Now let me come to the generally it is in the context of IBC and EPC companies that IBC is yielding more of liquidations and less of resolutions. And people give the numbers, and they give the numbers from the IBBI data, what IBBI publishes regularly. Roughly, I'm using the roundabout figures. They say that about 25% of the companies are yielding resolution plans, and 75% of the companies are ending up in the liquidation. So therefore, there is a problem. These numbers do tell a story, but not the entire story. First, look at, again, I wanted to emphasize that liquidation is not necessarily a bad thing. CIRP enables the market to first attempt to resolve stress through a resolution plan, whereby the company survives. But when the market concludes that there is no feasible, viable resolution plan to rescue the company, or liquidation maximizes the value as compared to the rescue, the company proceeds for liquidation. Thus, the code enables 2 ways of resolution of stress, first by resolution plan Failing which by liquidation. Liquidation is not necessarily a bad thing. The market usually rescues a viable company and liquidates an unviable company. As I was giving you the data, the companies which have been rescued on average had assets valued at liquidation value of those assets was about 22%. But the companies which have proceeded to liquidation, the average value of the liquidation assets of those companies was about 6%. Take the examples of Khotiringa Minerals Limited or Kid Healthcare Limited, which caught the media attention. They together owed about 8,000 crore to creditors, while they had absolutely no assets and no employment when they entered CIR. There are quite a few companies which have negligible assets or are defunct when they enter CRP. So having less liquidation value, having little asset can be a problem, but it's not that if there are real the resolution professional and committable creditors, they really work the way the IBC expects them to work, there will be resolution applicants. Some of you are from the capital market, you know that in capital market, I gave you the example of IPO. You have seen the IPO of Uber. So even if there's no prospector making 1 rupee, there are investors. If the price is right, the most rotten tomato sells. So what is required is that this UOC and RP have to be a little more careful, and how that I will tell maybe a little later. So the does not have asset really does not make much difference. But the companies like Khotiringa, but if there's some asset, there's a hope for recovery. But if there's absolutely no asset, I gave you example of Khotiringa and the biotech or Kid Healthcare, they had absolutely zero assets. They owed 8,500 crore to banks, and when they liquidated, there is a zero value. So the newspaper headlines told that this is what IBC has done, but not telling the other side of the story that when they came to the CIRP, they were existed only in the records of the Ministry of Corporate Affairs, did not have anything outside that. So what IBC does is it really tries to maximize the value of the assets available, but not the assets which do not exist. So therefore, I just wanted to tell that you should not be fretting over the liquidation in the deserving cases. Two things. One is that liquidation is not necessarily bad because the resources stuck up can be used for other purposes. And this liquidation is happening in a deserving cases. It's not a viable company is getting liquidated. Number wise, this is the situation. But if you look at the value of assets rescued, the 25% of companies rescued had assets, distressed assets, 75% of the distressed assets. While the 75% of companies going for liquidation accounted for 25% of the distressed assets. But this is all that which completed the entire process. But resolution does not wait for the resolution plan or liquidation. Many things happen beforehand, particularly because of the provisions in section 29A, which has led Supreme Court to say that a defaulter's paradise is lost. So a debtor makes all out efforts to prevent the stress. It resolves stress on its own when it is imminent, much before it translates into a default. It makes all possible efforts to settle default to prevent filing of application for initiation of CRP. Even after an application is filed, it tries hard to resolve the stress to avoid admission. It continues efforts to resolve stress midway through settlement, review, mediation, withdrawal under section 12A to avoid the consequence of a CRP. And there are examples of a settlement with the approval of the apex court. If you look at the resolution that happens on the way of the companies which have touched NCLT, 95% of the companies are getting resolved through IBC. Only 5% of the companies seeking resolution through court end up in liquidation, but of that 5%, 75% of those were defunct to start with. So liquidation or rescue is an outcome of market forces. Law is only an enabler giving choices and nudges towards value maximizing outcomes. The stakeholders decide whether to seek resolution, and if so, the mode of resolution. They weigh various options and choose the one that best suits their needs. They will not choose prudential framework or scheme of arrangement or IBC if they find that the outcome under this choice is not consistent with market realities. Further, when they use one option, let's say code, they have a choice between rescue of the company and its liquidation, and they prefer liquidation when it serves their interests better. So the invisible hands of the market work towards the best outcome, which we should accept and respect. There's some confusion about the value maximization. Because it does not maximize the value of the creditors, apparently, some companies, particularly EPC companies, get into liquidation. I think that needs a little more sensitization, a little more understanding among the stakeholders. The value is kind of a misnomer, and it has several context-specific meaning in the commercial world, and one needs to tread very carefully. It is not something that the problems arise. There are several dimensions to this. One is that though the code talks about value maximization, the committee of creditors at times has a dilemma that whether the resolution plan should maximize the value of the assets of the CD or realizations for the claimants or both, whether to maximize the interest of the corporate debtor or of the claimants. Supposing somebody is infusing funds to the corporate debtor, that will improve the value of assets of the company, but may not improve the realization for a claimant or a creditor. Or similarly, a lower haircut can improve realization for a claimant, but may not improve the value of the assets. So the maximization of the value for claimants may not always maximize the value of the assets of the corporate debtor and vice versa. Further, the claimants are not a homogeneous lot. You have a secured, unsecured, pari passu, etc. So a resolution plan may yield different realizations for different claimants. So the creditor has a further dilemma whether to maximize the realizations for the class of claimants he belongs to or for all the claimants. There are also problems about, quite often people believe that this is a company which has come to CRP and the value of the shareholding is zero. That means now whatever remains is the value for the creditors. That may not necessarily be so in all cases. If it were so, the waterfall in section 15.3 would not be providing a priority to the equity shareholders. So a default, which is a trigger for CRP, does not necessarily mean that the value of the equity is completely eroded. So withdrawal of a large number of applications for CRP before or after admission, in fact quite a large number, and satisfaction of all claims in full in some CRPs evidence this. So therefore the point I'm making is that while the COCs should try to maximize the value, that is one aspect. Like in a capital market, somebody is selling shares, IPO, see the kind of effort the promoter makes to get the shares subscribed. Sometimes he gets subscribed 5 times, sometimes 500 times. The promoter brings a visibility of the value in his dream or project. Similarly, I think the COC need to do that. Make people see that there is a value in the company. And second, not get carried away by these fixed computed theoretical numbers called liquidation value, fair value, and since the resolution value, by resolution value they mean the value which they are getting, not that the value which the corporate debtor is getting. And at times they compare if they are getting less than the liquidation value, because the liquidation value is at least what they can get if the company goes into liquidation. They tend to not accept the resolution plan. And there are instances, even though the liquidation value was less than the resolution value, they have accepted, but it has been contested. It went in one matter, it went to the Supreme Court. I think you remember the case of United Seamless Tabular Private Limited. So in that case, the COC and subsequently the adjudicating authority approved the resolution plan that provided an upfront payment of 477 crore. But on appeal, NCA later directed that the resolution applicant to modify the plan to increase upfront payment to 598 crore, which is the average of the liquidation value given by two valuers. On further appeal to the Supreme Court, in Maharashtra Seamless Limited versus Padmanabhan Venkatesh and others, observed that there is no provision in the code or regulations which prescribe that resolution value must match the liquidation value, and the object behind prescribing the valuation process is to assist the COC to take an appropriate decision on the resolution plan. It reiterated that once a resolution plan is approved by the COC, the adjudicating authority ought to cede ground to the commercial wisdom of creditors rather than assess the resolution plan. I think in addition to what the value comes from the resolution plan, the code also looks at the possible other options of getting the value. So the decision should consider not only the value coming through resolution plan, but otherwise coming, like the law enables clawing back of the value lost in avoidance transactions, or possible recovery that can be made from the personal guarantors. So if somebody considers all the things, probably the committee of creditors really tries to create the value and make the value visible and try to pull the derived value from the sources which were typically ignored so far and finish the process quickly. Sometimes it is argued that the liquidation value is something at the time of the commencement of the CIRP, but when the resolution plan comes after 2 years or so, by that time the liquidation value has gone down. Resolution value cannot be compared. We can't compare apples with oranges. But why so? It can happen also. Sometimes we have seen the value goes up in the meantime. But the solution to that is to finish the process early. There is no reason that the entire process is in the hands of the stakeholders. Finish the process early before the value receipts. The entire IBC says time bound, start early, close early, and that is how you preserve the value, rather than getting into that the process is getting delayed and I am getting a value which is not compared. In any case, academic value computed has some serves the purpose of a reference, but it can't be the market. That is, computed value is uniform for everybody, but the people who give a resolution plan, so each CD has a different value for the resolution applicant. So therefore, I would suggest that we should try to find the value and not get into the formula-based approach that if A exceeds B, I will accept the resolution plan, otherwise it will go into liquidation. If it were so mathematical, the company would have been put on the stock exchange platform. Whosoever gives the highest value would have got it. It is not so. It requires application of mind, consideration of feasibility, viability, and it has to be decided by the boards. So therefore, we have to move to the real essence of the IBC, and with the support of IP, the example I gave you, Gujarat Urja, support of the COC, we would be able to resolve the EPC companies. Also, they are getting resolved today, and even their success rate will go up. Thank you. I close here. Thanks for giving me the opportunity.
Thank you so much, sir. As always, a very passionate, and we get to learn a lot from you. With the hands-on experience that you have in this entire space. We now move to Mr. Anant Jain. Anant is he's an investment banker, senior investment professional based in New Delhi and New York, and brings a global perspective to the alternate investing in India. I must thank him for supporting FICCI in putting together this conference and guiding us with your insights. Anant, for your concluding remarks, please. Anand, we can't hear you. Mr. Jain? Mr. Jain, can you hear us?
Maybe he's got a bad connection, I think.
Yeah, it looks like. Anand, is it possible? Can you hear us? No.
He keeps his
So I think
video.
there's a technical problem. May I request our Secretary General, Mr. Dilip Chinoy, to kindly propose the vote of thanks.
Thank you, Jyoti. Dr. M.S. Sahu, Chairperson, IBBI, Dr. K.V. Subramaniam, Chief Economic Advisor, Mr. Rashesh Shah, Past President and Chairman and CEO, Edelweiss Group, Mr. Anand Jain, Founder and MD, Payer Investments, and Mr. Salish Pathak, CEO and L&T Infrastructure Development Projects Limited. A very good morning to you, and on behalf of FICCI, I would like to thank each one of you for sharing your insights with us. Dr. Sahu, very eloquently, you actually not only brought out the salient features of the whole process, but also you addressed each of the issues and suggestions that each of the previous speakers had made. And infrastructure is a key pillar of the Indian economy and always been recognized as one of the most important enablers of economic growth. And development of the sector assumes great significance at this juncture, and it is bound to play a pivotal role going forward. We are hopeful that the discussions at today's forum will help in finding solutions to the issues of distressed debt in the infrastructure sector and facilitate investments in this space. Of course, once again, take this opportunity on behalf of FICCI to express gratitude for the support and guidance we've always received from Dr. Sahu, Chairperson IBBI, for all our initiatives in this space. We would also like to extend our thanks to Dr. K.V. Subramaniam, Chief Economic Advisor, Government of India, for sharing his insights. We truly appreciate the comments that he made and the spirit in which the comments were made. And we believe that the government and the regulator both are working to ensure successful turnaround of stressed assets. I would like to thank Mr. Rashesh Shah for so beautifully setting the context and always supporting our efforts here, and Mr. Salish Pathak, CEO, L&T Infrastructure Development Products, for sharing actually on the ground, experience, and of course, leading us through that great example and taking on Mr. Shah's concept of a caterpillar morphing into a butterfly. With these words, I would once again like to thank our esteemed speakers for joining us today and of being extremely supportive of FICCI's initiative. Apologies to Mr. Anand Jain. I'm sorry for the connection, but thank you very much for your support. Thank you, Jyoti, Abha, and Chiku and team for putting this together.
Thank you, everybody. Thank you, Dr. Sahu, Shailesh, and Mr. Shah, and ST for being there.
Thank you very much.
We'll be getting into the next session very soon, so participants stay logged in, please.
Yes, sir. How are you?
Distinguished panel of speakers today. The session is titled Resolution versus Liquidation and Possible Solutions. And the panelists with us today are Mr. Naseem Ahmed, Chief General Manager, Shastra at Punjab National Bank, Mr. R.K. Bansal, who's Co-Chairman, FICCI National Committee on Stressed Assets and Managing Director and CEO, Edelweiss Asset Reconstruction Company Limited, and Dr. Savan Godiawala, who's Partner Corporate Finance, Deloitte India. And the session would be moderated by Mr. Anu Prawat, who's Partner, Shardul Amarchand Mangaldas and Company. With that, I hand over to you, Anu.
You are on mute, sir. Thank you, Chiku. We have a very distinguished panel here today. We have Mr. R.K. Bansal, who is also the co-chairman of the FICCI National Committee on Stress Assets, and is also managing director and CEO of Edelweiss Asset Reconstruction Company Limited. Mr. Bansal is a chartered accountant by profession. He started his career in IDBI in 1983. Now he holds more than 33 years of experience covering both development banking and commercial banking. Mr. Bansal retired from IDBI Bank, and now he's the chairman of the CDR, and he was also the chairman of the CDR Empowered Group. He's been handling many of the large stress group accounts and exposure as CDR EG chairman. He is spearheading the efforts of Edelweiss Asset Reconstruction Company. He's been at the forefront of this particular practice area, and he's immensely experienced, and he has deep knowledge of the sector. He has worked closely in many of the insolvency resolutions, and we have, I know him personally, we have interacted a lot in some of them. We also have with us Mr. Savan Godiawala. Mr. Savan Godiawala, he's also a chartered accountant. He's actually not only a chartered accountant, he's actually many qualifications to his credit. He's a PhD in management. He holds a bachelor degree in law and commerce, and he's a qualified insolvency professional also. He's a visiting faculty at Indian Institute of Management, Ahmedabad, for last 13 years. So, you know, his scholarly, I think, achievements are many, and it will take a lot of time to explain to them. He's been also deeply involved in the insolvency resolution processes. Presently, he's also a liquidator of one of the largest EPC companies in India. He was also the resolution professional for that account. And we will be enlightened with his experience of handling the insolvency process and the liquidation process of this largest EPC company. We also have Mr. Ahmed. Mr. Ahmed has been with the Punjab National Bank for last more than 35 years. He has more than 35 years of experience in the banking industry. He's been spearheading the insolvency resolution processes at Punjab National Bank. He heads a very efficient and very diligent team, which helps him out in handling the insolvency cases. His task is really difficult, and at the same time, it's filled with experience, and we like to hear from him on his experience of handling the insolvency cases and the changes in lenders' approach over the years. I welcome all the panelists. The discussion today is about the insolvency resolution in the construction space. All of us know that the law has developed over a period of 3 years, and now we have good clarity about the processes in the insolvency space. But at the same time, there are certain things which the processes do not help, and those are driven by how the market perceives the business. The same is true with the construction industry. I heard Dr. Sahu saying that the government policies should be neutral, and the logic is quite compelling. But at the same time, there has to be a different approach, at least from the lender's side and from the side of the other stakeholders, in how they perceive different sectors within the overarching neutral government guidelines on resolution processes. In this context, the construction industry also deserves a different approach. We all know that construction industry deteriorates in value very fast the moment the insolvency is initiated. We have several examples before us which bears testimony to this, and therefore one of the thought is that for as far as the construction industry is concerned, I think the focus should be resolution outside IBC. But given that we have a robust insolvency resolution mechanism under the IB code, what could be the various methodologies, processes that could be deployed to make the insolvency resolution in the construction space really efficient and also yield result? That is something we'll be discussing in the panel today. To start with, Mr. Ahmed, I would like to ask you, what has been your experience in handling the insolvency resolution cases so far, and especially in the context of different sectors with a focus on the construction industry? What do you think that the approach should be, and whether lenders have started now thinking of adopting different approaches for different sectors when it comes to insolvency resolution? Over to you, Mr. Ahmed.
Good morning, and thank you, Fiki, for inviting me on this panel. I would be concentrating more on this EPC segment, because in other type of companies which are facing a stress, there is assets lying there. But EPC is a different type of ball game, and in contrast to an asset-heavy company, the core assets for an EPC company are the pre-qualification, the order book, and the key personnel. And overall value of an EPC company is largely dependent on these core assets. Where there is assets, the factory, building, and other things, but here there is no such assets, then we have to take care of that, how we are going to resolve. And when one company, such company is coming to IBC, then there is a complete value deterioration, and the spirit of IBC to keep the company a going concern. We want to save the corporate debtor, but in this case, EPC, mostly all those accounts, if we are going to IBC, it is going into liquidation. For the prospective resolution applicant on EPC company, the value of PQ is inextricably linked to the key personnel. And what the key personnel is the major contributor of EPC company, because they will be executing all those contracts and all those constructions. But when the company is in a stress, these key personnel leave that company, and finding a suitable buyer may prove to be difficult for the resolution professional and the committee of creditors, since they may be disqualified under Section 29 and other things. The above mentioned complexities and issues surrounding the insolvency dissolution of EPC company severely limits the number of prospective resolution applicants. As I said, that finally it will go into liquidation. What we do in our company and what we do in our bank, and when we discuss with the distressed company, we try that we should go outside IBC system, and we should go for restructuring of debt. And then second, the major thing we are facing, that despite all those work they have undertaken, they have completed it, award has been given in their favor, but again, all those departments, mostly government departments or the big company, then they are litigating it in the different courts. And it takes 4, 5, 10 years to decide that. So then we have to see all those things. If we are going IBC model, then there will be a liquidation of the company, and the value over the years, all these companies were partners in development of the company. They have executed so many big projects, still they are doing. And when the thrust of the government is infrastructure, then it is our duty as a responsible lender, as a public sector lender, the value of the company, expertise of the company is to be maintained. So at our bank, what we are trying, that we are going in for restructuring, and the problem with the restructuring is that all those awards and judgments in their favor, they will come after a lag of nearly 2, 3, 4 years. So then we try that, yes, that will be kept separately. We will be waiting for that. And we have to see that some capital the promoters should bring in. We should also finance them. And then whatever recoveries are happening from the work done by them, some part of that should be coming for reduction of their debt, and some part should be released to the company so that they should be in a position to execute further orders. They should be in a position to keep their key professionals, and they should be in a position to keep that company functioning.
Thank you, Mr. Ahmed. I think you made some very, very important points that, unlike any asset heavy company where, the recovery or the, business can be dependent heavily on the assets, and therefore, the value maximization is quite easier as compared to the EPC companies where, the only asset base of that company is the pre-qualification, the order book, and the key personnel of that company. And therefore, the liquidation is unlikely to yield any value, because you will not be able to sell pre-qualification as an asset class, or the order book as an asset class, or the personnel as an asset class. So therefore, the only way to preserve the value and for the revival of an EPC company is through a resolution.
Yes, I would like to add one thing, that there is in all these EPC companies, huge bank guarantees are outstanding, which the company has given to different departments. And when liquidation process starts by any operational creditor or anyone, we are having a threat of devolving all those BGs, and thousands of crores are BG are there by EPC company to different government departments and company, blue chip company where they are working. And we will have to, we all are having means there is a stress on our capital and then provisioning requirement. If all these bank guarantees start devolving, then the provisioning requirement of the bank will increase. So we have to see also that the company should be going on, and all those contingent liabilities should not become a fund-based liability. Non-fund-based liability should not become fund-based liability. This will create further stress on the company, the EPC company. It will create a stress on the banks, and then whole process will be derailed. Then it will be very difficult, or if all these bank guarantees are invoked, then it is very difficult to keep that company a going concern, considering the debt burden and the interest servicing burden on the company.
Yeah, I think that's a very pertinent issue, and of course that is where the advantages of the resolution versus the liquidation has to be seen. Of course, there will always be a this confusion over how to preserve the bank guarantees, because if you go into liquidation, there's a threat of invocation. If you continue in the resolution, there is still a threat, but yes, there is a high chances of revival, which leads to saving of the bank guarantees. Thank you very much, Mr. Ahmed. Now, picking on your key features of an EPC company, I would like to pose a question to Mr. Bansal, who has been at the forefront of the investment initiatives. Mr. Bansal, these three asset components that Mr. Ahmed just laid out, the pre-qualification, order book, for an EPC companies. How do you think investors perceive an EPC company? And do you think that they with these three ingredients available, they come forward, they will come forward a plan for revival of the company?
Good morning. Thank you, Anu. See, I think if we really analyze what has happened from 2014 onwards, when the whole stress started, a lot of EPC companies, and especially I think we had a number of EPC companies, and many of them went into problem because of the delay in receipt, because of the delay in payments, and a lot of cases going into arbitration, etc. Now, and I think as a banking, as a lenders also, we have also realized that initially there was a whole this thing that we will go to IPC. So, but I think as Mr. Ahmed also said, it is right that companies typically are not a fit case for liquidation, I mean for IPC. Now, if I really look at the first list of RBI, we had 3-4 companies. One went into liquidation, but not yet liquidated, I think. Then Nira Infra, I think nobody knows where is it. Then Jyoti Structure, we tried to implement a plan and still does not come. In the second list also, we had number of cases, whether IBRCL or something. But I mean, instead of naming them, I'm only trying to say, we have not been able to find a resolution. Some cases like Soma and all, which tried to find a resolution outside. So I think the best course of action in such cases is the resolution has to be found outside. That's the first thing. Now coming to your question on investor interest, it also depends where is this company, at which stage it is this company. I also have in my portfolio one company which had 4,000 crore of debts, and maximum receivable we feel can be 400, 500 crore over a period of time. Now at this level, there is the interest of the lender because there are guarantees pending of almost 200, 300 crore rupees, which can be released if you complete those projects, and those projects need to be completed. Now here the question becomes that it becomes crucial to have the support of the existing management or promoter, whichever case may be, whether 29A eligibility or not, because of 2-3 things. One, you have to deal with so many people where you have taken contract from, and many times these guys are only aware of the details. Then you have to follow up on your claims plus arbitration, etc. That also requires lot of follow-up, and I think existing management will be in a better position to follow up that. The interest from the lenders is that my guarantees which are there, if they can be released instead of getting invoked, as Mr. Ahmed also said, and just losing money. We have seen earlier some entities who the guarantees left and right, and if it goes to IBC, they were doing that. Of course, IBBI tried to stop it, but still we have not succeeded fully in that. So I think there is an interest, especially in those companies which have still survived, which are still having some orders. The amount required is less for investment in that sense. The only thing which creates some issue is always to continue with these bank guarantees. And many times when we talk to the banks, in fact, banks expect even for this guarantee, that type of amount, which becomes difficult. I would say today, whatever companies are left, actually, many of them anyway have closed. So today, those companies which are left, we need as a country, in fact, we have very few EPC companies today. We need all these companies now to survive. And we have to work with the investor, which requires only small amount. But the major support, as Mr. Ahmed also said, support is required from the banking system, that you work alone. If you have to work along, I think even an JRC or a stress asset fund will be keen to do work, but the risk of IBC remains always, so that becomes always a challenge for the lender actually, new lender if some fund comes. So that understanding we have to have with the banks that guarantee invocation, or IBC at least will not be tried as an option. I think there will be interest if we can work around, and it is possible. I think we have seen a few cases happening like that.
Yeah, I think Mr. Mansur made a the bank guarantees. Bank guarantees, I think, is a very sticky point in the resolution of the EPC companies. And I think the issue around the bank guarantees is that, bank guarantees are the life, or you can say that, that's the oxygen for a EPC company. Now, while the lenders definitely would want the entire bank guarantees to be secured. But right now, looking at the investors' interest, it is very difficult to provide a solution for all of it. But I think you made a point, instead of resuming big, you I think can start with a smaller setup with a need for a smaller amount, and with the help of the bankers who available some of these facilities, with of course a good commitment that most of their bank guarantees need to be saved from invocation. I think at least as far as the insolvency companies which are in the insolvency is concerned, I think that's the best solution for them, because liquidation is anybody's guess. We have seen the liquidation processes itself are not developed fully from a regulatory perspective also. So absolutely very important point. Moving to Mr. Bodiawala, I mean, someone who has seen the full spectrum of how the insolvency resolution started for the one of the largest EPC company that you are handling, and the efforts were made to resolve it also, and then unfortunately it led into liquidation. Quickly, Savan bhai, what has been your experience, and what do you think where things could have been done right?
Yeah, thanks, Anup. I think interesting perspective, of course, from Mr. Ahmed and Mr. Bansal. And I would initially, talk about something that they mentioned, that rightly so, that where is the asset, where is the value? The asset and value, these are fragmented assets lying all over the place, but this is the PQ. This is the contracts that I have on hand, which I am supposed to execute. And then this is the manpower, which is so very important. So the 3 points which you rightly mentioned, that when you take over a company or you get into the administrator role of a company, the biggest challenge and the first thing that you will have to ensure is to retain the contracts or retain the people who could execute this contract to preserve the value, because that's something which is very important, preserving the value or preserving the going concern, as we would say. Protecting the assets, certainly there is a big challenge, because these are fragmented several places, that EPC equipments, but the real value is coming from. Now, the first thing as you enter into the resolution or an IBC is going to be your auditor questioning, how do I certify you to be going concern? So one is the mandate to preserve the going concern. Another is the auditor also saying, where is the going concern status? You are already in a difficulty. You are already getting liquidated damages, which your principals are invoking. You already have people who are leaving you, who will execute the contracts because now they are worried about their career and their future. And in the process, so what essentially I want to say, and one point that Mr. Bansal rightly mentioned, that ideally resolution we need to find outside also, because the value erosion in a typical EPC company happens very fast. The value erosion, the value comes from that contracts and PQs in my past, and then of course the people executing. And when that starts dwindling, the huge erosion happens, and that is a very fast erosion versus a typical brick and mortar factory manufacturing a product, having the set of vendors and customers and distribution logistics that they have settled. So that is one important thing. Two is the resolution plan is here not about the product and capacity and performance and profitability. The resolution plan is about what I have as an EPC company in terms of the contract, which the resolution, prospective resolution application will be applicant would be able to carry further. So if he sees that there is an iota of difficulty in terms of dealing with the principal, or with in the execution, or the liquidated damages are coming through, or the delays are going to, after he comes in, terminate. Now after he comes in and if the contracts get terminated, he cannot go back to NCLT and say, gentlemen, I never bought this company. So that is where the resolution plan becomes a very tricky affair. And we would have taken a valuation from two very senior valuers. There are valuation on fair value, there is a liquidated value, both also available to the COC. but the resolution applicant has a different perspective of valuing it based on his competence more than the corporate debtor's competence also at that time, based on his assessment of where he will recover the money rather than from what assets the recovery is going to be coming, which the valuers would have typically done. So this is what is creating a big gap between the expectation of COC at times and the expectation what the resolution applicant would be putting forth, even while he would be explaining that what is the base of his valuing a company in a certain manner. Another perspective that I would give is some of the EPC companies, they would be doing EPC of several businesses. Now here I am going to a resolution applicant or several of them for them to give me a resolution plan. Now, one fellow who is keen on doing an EPC of power company is not keen on doing an EPC of a road company. He is not keen on EPC, or he is not keen on a mining right. Now, if I have in a EPC company several businesses, then maybe how do we address a situation that multiple resolution plans are handled? So that typicality also would come in, wherein the fellow will say, oh, I am not concerned with road. I will value road as zero. I will value other EPC businesses only where I am concerned and I am make money and I'll continue the business. I will not, I may just discontinue the other businesses also, which otherwise has a value if you look at it from an RP point of view or a bank point of view or a valuer's point of view. So that the difficulty of different businesses, different locations, contracts, and that change of ownership converting, because the principals are not government companies in all cases. One another perspective that I would like to bring is many of the EPC companies would also have a subsidiary or several of the subsidiaries, whether as an operating company or again an EPC doing a super specialized EPC. Now you come to me where I am given only a job of resolving an EPC company without giving me the authority on resolving that subsidiary, which is also working very closely with me, or I have a control, or which has a value which comes to me when it comes to the valuation of the EPC company. And if I don't bundle them together, if I don't bundle all such companies together, then the applicant is worried that I will value your share at X value, but unless your creditors of your subsidiary is comfortable, I would not want to give you value, because I will not value isolated share capital or equity of a company, which otherwise I am not sure how it will pass on to me. And tomorrow, if there are shares which are pledged or if their value eroded over there, if the control is not coming to me, then I may not be able to survive or extract the best value. So I mean to say that if there are cases which are of a similar nature, a group resolution is very important to actually get a value out of the EPC company and underlying assets, whether they are super specialized EPCs or they are operating assets also, which otherwise where the investment values are. In the liquidation, of course, the biggest problem comes in as soon as the liquidation is converted from resolution to liquidation, there would be automatic termination clause of contracts. Now again the liquidation value, or there is a reason that this contract PQs or order book when we are talking about, and then there would be a principle coming that as an automatic termination of a company under liquidation, these contracts now will naturally get terminated, remain invalid. Then there is a huge value erosion all of a sudden as soon as the liquidation order comes into play. Another issue which we are facing, and which would be that these are typical companies with a lot of litigations. Like there are a lot of BGs, naturally being a EPC, there's a lot of litigations also, because they work at several locations, several businesses, several assets, several right of way in some case, right of usage in some cases, and of course delays and liquidated them. So now actionable claims is something when as soon as it converts into liquidation, while the valuer would look at it as something which will continue, or that how do we transfer, how do we assign, how do we call them as part of the unsold assets at all? So that's something which also is a typical difficulty that are faced when you try to extract value or get value when you're doing liquidation, whether as a going concern or even piecemeal selling the businesses by themselves. and where the erosion is. So I think once the EPC company gets into a liquidation, there's a huge value erosion, no doubt about it, because the major value, maybe all the value which is coming from the business gets is difficult to then get that value. And also the issue of sustaining and monitoring and the cost that we do in protecting even that fragmented several small assets or equipments that lying at the client place. One more point before Anup, I hand over to you. I would this is my experience, that there are assets which are assets equipments lying even at the client place, and the client says that I have lot of either litigation with you, receivable from you, commitment from you, you have not followed the covenants which we have agreed upon. I will not let your assets also be leaving my premises. Now here is another issue which is happening, that it is my asset. The liquidation estate very clearly mentions that this is the asset which I have a control on. The corporate debtor can sell, auction and sell it, but then this doesn't happen in the real world in several cases, where the client or the principal or the lenders of that principal would take an objection, not allowed to release the assets. And maybe final one point that I remember is the distribution of unsold assets. It's not easy to sell every single asset, and I think that would be the case in every case. That to the last pencil or a chair on a table, I won't be able to sell everything. Now this has to be distributed among that 2, 3, 5, 20, 30, as many creditors which fall under the waterfall mechanism, where as the value could be. Now how do I distribute this? There should be a mechanism which should be structured in the law, that this is to be distributed. It goes to whom we know. 53 is clear. But how does it go? Do I have a trust? Do I have any agency? Do I have a way which I just park it over there and then the guys will take over 53? That is something also which is creating a difficulty when in terms of especially the EPC companies, where you don't sell it as a factory or a full thing as a bundled thing. So maybe these were some of the points that which I think can be discussed, highlighted, and maybe deliberated even with the agency, senior agencies. Yes, over to you, Danu.
Thank you, Sawan Bhai. I think, the way you have explained it, I think it is, divided into a pre-liquidation, which is the insolvency resolution phase, and the liquidation phase. One conclusion is definitely there is that, in the liquidation, you have lots of uncertainty. Even if, you have huge arbitration claims. Somebody can hear me?
I can hear you, but I think Mr. Bansal is unable to hear you. Is this
Mr. Bansal, can you hear me now?
Yeah, now I can hear you. Thank you.
Okay. So one conclusion, I think it's irrefutable, is that the is a very uncertain phase for a company which is in business. We all know that the construction company huge fixed assets, so the recovery from the fixed assets is not a possibility. Beyond that, the other asset category, which I just heard from you, could be arbitration claims. But we did a lot of analysis on this particular asset class, Savan Bhai, and one of the legal complication is that the Indian laws do not allow the assignment or a sale of a mere right to sue under the Transfer of Property Act. That, considering this as an asset class in the liquidation phase, again becomes a challenge. And given that the liquidation has a limited life, company has to be dissolved unless you sell it as a going concern in the liquidation phase, which itself is a very complicated subject. The arbitration claims are bound to die. Now, and then the other aspect of the liquidation, you said that the distribution itself is very confusing as to how you distribute amongst the various lenders. I think it will require the law to be developed fully, more cases to go through the rigors of liquidation, and then we come up with some kind of a clarity, because the way the securities have been created in the Indian context is right now very, very, I would say crystal clear method of dividing the securities among various lenders. The confusion still remains. We still do not have a fully developed law on to the subservient charges which are created without taking consent from the other lenders. So those kind of confusion, and amidst this confusion, going into a liquidation definitely is going to cause a lot of value deterioration for the lenders. Now, very quickly in the resolution, therefore we need resolution. There's no doubt. Some of the key aspects that you raised during during the insolvency resolution phase, which is the group EPC, the EPC group companies, where the subsidiaries handle some part of the EPC businesses. You also mentioned about the different segments in which a EPC company operate. It could be oil and gas, it could be pure road, it could be power plants, it could be others, and therefore it is difficult to get an investor who may be willing to do all of it together and put up a consolidated or a comprehensive resolution plan. So I think need for innovation in the resolution of EPC companies. While the rules and regulations may be constant and neutral, but I think the approach of lenders need to now be proactive. They need to innovate a little bit. And I think if I go back to the Bankruptcy Law Reforms Committee report, Soundbhai, which clearly mentions that the law is silent on how a resolution will be done. And Bankruptcy Law Reforms Committee report also acknowledges that it is the market which will decide which resolution is perfect for a given corporate debtor. So I think there is enough room for innovation. The code does not lay down a comprehensive process of what could the resolution entail. In fact, now the resolution plan definition itself has changed to encompass the mergers, demergers, amalgamation, and all sort of things. And in fact, the regulations which is framed by IBBI, it also contemplates that in addition to the continuation of the corporate debtor, the plan can also contemplate sale of the some of the assets, some or all of the assets. So I think we need to innovate a little bit during the insolvency process. Also, we need to, I think the lenders community as a whole need to identify how these things need to be structured and sold. And there is enough room for innovation, I think, on this account. It's just that I think all the stakeholders need to work together. I think the resolution professional, the lenders, and the potential resolution applicant, they all need to, I think, work together to see, what could be the various permutation and combinations on this. But I think one irrefutable, I think, conclusion is that liquidation is really, not the solution, at least for the construction company. Now, coming back to Mr. Ahmed. Mr. Ahmed, given that there are complexities in a construction, the insolvency resolution for a construction company, do you think that you as a lender would look at the resolution for the EPC companies different as compared to the other resolution, and maybe participate more in the sense that you may not get all the value upfront, but as long as there could be a chances of revival, you maybe participate more and then seek a upside whenever the revival happens? Or you think that the approach today is still on recovery? So just a quick reaction from you, Mr.
Yeah. Just I would like to take care of what are we taking, what steps we are taking to overcome challenges of EPC sector. when it is a standard assets and when there is a stress in that. Generally, EPC players have developed skill sets in the core subsectors, road, energy, transport, urban infrastructure, etc. Now we see that they should be diversified. One EPC contractor should have capacity to do work in different sectors. Because if there is downturn in a particular sector, that EPC company should be in a position to compensate from other sectors. Second thing is that the major receivable profile of EPC companies includes the government organization or PSUs. Now my suggestion is there should be a process where all these things, faster billing clearance from the government sector PSUs, if it is happening properly, then that company will survive. So there is a need of policy intervention. What is happening in government sector? Even arbitration is over, award is there, but they feel for an official working in any capacity, go to the court, why should I be paying? Then I will be questioned in future. You know that psyche of in public sector banks and other places also. But this is hampering, this is important sector. Then there should be a system of faster arbitration process for EPC so that cash crunch do not hamper other projects. Now coming to our bank, what we are trying to do, we are avoiding going to IBC at our own. We are trying either if there is value in the company, capacity in the company, then we are going for restructuring, or otherwise we are going for OTS with the customer because that personal stake of the promoters are there, there is certain value, and the company knows where their assets are lying, how they are going to realize that asset to come for this OTS. Then there is 9 March 2019 circular by the MOT for this road project. So huge money is lying in, locked in this road projects. Then that circular is there. Whatever money has been invested in struck project or in terminated project, then we are trying and talking, and I am happy that NHI is also coming forward because they want to resolve all those cases. Going to IBC, selling and other thing, it is not going to happen. And then we have to see the finally the change of management if management is incompetent. But I'm really, it is a very precarious situation for the country as a whole, that many good companies who were doing all complicated projects like Gaman, SCC and others, they are all under stress. Then it is a requirement by the government and all agencies and all business bodies that what is the major problem, and we have to take care of that. Only banker cannot solve it. Promoters are in stress. Everyone has to work that this is because when we are there, again I'm at the cost of repetition, I'm saying when there is pushed by the government for infrastructure projects, who will going to complete all those projects, and especially in the border areas and especially big power projects, so that we have to work together. This is my suggestion, and bankers are doing their duty, and especially in public sector banks and all public sector banks, they are in the consortium, and we are trying to do that.
Thank you, Mr. I'm told that we are running out of time. So one last question before we wrap up to Mr. Bansal. Mr. Bansal, one aspect is the EPC resolution going forward takes place outside IBC, given given the result of many insolvency processes in the EPC sector. But at the same time, I think we have large EPC companies which are still in the different phases of insolvency. And these large EPC companies have been instrumental in taking up the infrastructure initiative that was taken by the government. Now, given that these are massive experiences which are at the verge of a few words from you, Mr. Bansal. What do you suggest that how it should be tackled when they are in the insolvency process?
I think there's no immediate one-way solution, but I would still suggest we should allow 2-3 things. One, if possible, we should allow those cases to come out under 12A. The second, I would say that as a government, we should request all the departments and all the entities not to invoke the bank guarantees immediately, and we have to work along with them. Now, the third thing, perhaps, which has been seeing some traction is can we sell these claims and arbitration awards, etc., also separately, which has been allowed to some extent by IBBI by some amendments in the rules. But I think that is also required, because if you have to have some liquidity in the company, I think that is the only way perhaps we can look at it. With lot of difficulty, like say NHI has agreed nowadays in IPC, at least even ARCs they are recognizing. Earlier they were not even recognizing ARCs. I think if all of us work together, and NHI I think has become quite positive recently, at least last 1 year, 1.5 years, 2 years. Basically, we have roads, power segment now. We don't have many EPC company except maintenance of power, etc. So most of the companies are as of now mainly in the road segment or otherwise building construction. I think there is a solution, but it requires all of us to work together. Investors would be there, but you can't expect investors to put a lot of money today in the company and take out maybe the earlier lenders. I think all of us have to work together. It's possible. It requires, I think, as you rightly said, we have looked into from the earlier also committee also and all. I think it requires some support from all of us. It is possible, but.
Thank you, Mr. Bansal. I think it's a very interesting discussion. We've heard from all stakeholders. We've heard from the investor side. We've heard from the resolution professional side and the lenders. And I think one view is that to the extent possible, the revival must be attempted because liquidation right now is not the solution. I thank you all the panelists, and over to you, FICCI coordinator.
Thanks, Anup.
Yeah. Thank you.
Thank you for your
Thank
time.
you.
Thank you. Thank you, Mr. Ahmed. Thank you, Mr. Bansal. Thank you, Mr. Godia.
Thanks, Anup.
Okay. Thank you. How is it done? We have to vote.
We just leave the meeting.
Okay.
Being tuned in, ladies and gentlemen, we are about to commence the next and the last session for the day, which would be moderated by Mr. Anant Jain, founder and MD, Payard Investments. Mr. Jain, over to you.
Thank you, Chiku. Thank you, and welcome to everyone to, I think, what will be a brilliant panel. We have on this panel, I would think, more than 60% of the banking assets of the country being represented by the leaders of their stressed asset groups. And they're in a privileged and unique position to shed light on some of the core issues that affect the EPC sector in India, and also the infrastructure space. So the general preface to this panel is, and the background to the panel is that infrastructure cannot really take off in India until the EPC companies are strong in India. Construction companies are the plumbing of infrastructure, and for the Indian government to spend the $1 trillion that it expects to over the coming decade, and for Prime Minister Modi to reach, and for the country to have its ambitions of 5 trillion and then 10 trillion economy being met, we need to have very strong EPC companies at the foundation of an overall economy. Perhaps it is embarrassing that a country of this size, as we are, just has one L&T. There should be dozens of companies, perhaps not all of the same size, but there is scope for having multiple L&Ts, maybe 20 and 50 EPC companies, all of which are multi-billion-dollar companies. And that is what is required in order to fulfill the country's ambitions. Now, Many of you may have been in the morning session. For those who weren't, maybe I can just quickly summarize what was said. We had a distinguished opening with Rashesh Shah from Edelweiss focusing on how revival is a core aspect of the IBC and not merely the recoveries. And he spoke about how a balanced outcome must be achieved for all stakeholders without ignoring the market forces. And this is where Dr. Sahu started talking about how it is important to respect market forces. And sometimes liquidation, however abhorrent it may be a good situation for those companies which have no value and which cannot be revived. But for those which can be, they definitely need to achieve the attention of all the senior bankers and of the country, and perhaps of the political leadership as well. Dr. Subramaniam, the CEO, spoke about how the lenders themselves, and as he put it, the elephant in the room, should have higher governance standards, and the quality of underwriting is very important in order to achieve the balanced outcome that everyone spoke about. And Shailesh Patel from L&T had an interesting point, which I also agreed, which is that it is not merely an economic issue. You see, EPC companies exist within an ecosystem in which there are multiple players. There are regulatory agencies responsible for permissions, etc. There are counterparties, which are often the government clients or government agencies or government companies, which upon payment delays can cause a working capital crisis, which essentially leads to the crystallization of liabilities and hence a fund-based liability, which an EPC company is unable to address. Anyways, with that as the background, let's go straight in and introduce the first panelist. I want to invite Mr. Chandra. Mr. Ashok Chandra is the CGM, the Chief General Manager at the Union Bank of India. And he is presently handling the recovery, legal, and the entire stressed asset group in the central office. Mr. Chandra brings a unique perspective, and we'll invite him to speak about his lessons, or the lessons that the stressed asset groups is learning from addressing a large portfolio in the infrastructure space. To you, Mr. Chandra.
Good morning and hearty welcome to all of you to this crucial discussion which we are going to have now. I think we are all aware that EPC is plays a very, very definite role in the development of any economy. You take, for example, European countries or America, even in the Asia also, whether the Japan, Korea, and China. I think all these countries, they have played a significant role. And that is the reason we see that good infrastructure has been created in all these countries. And that paved the path for the development of those countries. Even in India also, I think all of us, we have seen that we have done exceedingly well for the last 10 years. If you see whether the road, port or airport infrastructure, I think our country has also done exceedingly well. Having 54,82,000 kilometers of the road network is the second highest in the world. So that is the opportunities that is available for the EPC countries in India. So I think latest government policies also, I think they are very, very clear, and they are going to have the supporting role to the EPC sector. Because the EPC sector, which generally the issues which they find it for the bankers' point of view also, mainly the core issues are the security things and the margin, the BG issues, inherent risk which is involved by way of the primary and collateral securities, which is always, there is an issue with all the EPC countries, EPC sector. So for that, I think Government of India has recently, which is announced, and it is really healthy welcome by all the stakeholders, that is performance security that has been reduced from existing 5 to 10% to 3% of the value of the contract for existing contract also. I think really it is a very, very welcome sign, and that will definitely help both the EPC as well as bank also to go for the funding, non-fund based facilities to all these EPC contractors. Second, the good development with the Government of India has announced that they have waived the requirement of EMD for all the central government projects. I think that is also a very good signal to have that EPC in the developmental path. The third initiative which the government has announced is payment. Earlier, all the payments were being settled on a quarterly basis. I think that also they have made it very clear that on a monthly basis, all the payments will be settled. Because that is one of the major issues which, from the banking point of view, we have seen that the settlement itself was taking very, very long time. And that was creating the working capital issues with all the EPC contractors. See, in the 21-22 budget also, if you see the capital expenditure that has been enhanced for 34.5%. And if you see in the monthly terms, it is 5.5 lakh crore to push the growth for the infrastructure sector. I think government has also announced the development financial institution. So all these measures, if you see, there is a definite, the guidelines is there for the entire ecosystem that government and the regulator, they are very, very keen for the development of the EPC infrastructure. Now, the bankers, I think we need to play a really very, very vital role. And I have already mentioned that basically the two issues which we are facing in this the EPC funding, one is that equity participation, and second is the security issue. So equity participation, if we take for example, I think our experience says that there is major issues are involved in this equity participation, and that is one of the reasons where we have found the sickness in for the last 7-8 years, where the equity participation also we found that there are certain diversions, and equity also is being funded by the group companies. So this is one of the major issues. But the regulator has come out very, very clearly the guidelines when they have instructed very clearly that any bank who is doing the funding and opening of the current account with any non-fund based banks, I think that has been prohibited. So definitely that is going to have the clarity on the cash flow mechanism, the ASM which is being involved in all these cash flow verification. I think those things are definitely going to help in the entire monitoring system of the funding of the EPC funding. Second thing, I think the security. I think there is an inherent risk involved in that, where you talk about the primary security or the collateral security. I think if we talk about the security and do the funding, I think absolutely in this particular sector it is not possible. So bank has to take a prudent decision whenever we find that good projects are there, background of the promoters are good. Definitely, we as a banker, we need to take that positive action in that direction, and we need to support that EPC concerned firm. So we are very, very clear about that, and our bank, Union Bank of India, is also very, very active in the EPC funding. I think the HAM model, which has been suggested by the government and going on for the last 3-4 years, I think that is also the model which is very, very fruitful from the point of view of funding as well as to the EPC sector. So we find that opportunities are there for everybody, all the stakeholders who are involved in this, and good ecosystem has been created. We find that whatever has happened in the last 5-6 years, I think the situation has changed now, and we are in a very good position, and we will definitely see a wonderful growth in this particular sector. And if the EPC becomes a very, very healthy sector, I think this will have the multiplier in the entire economy, and whether the unemployment issues or the other related issues are there in the economy, I think definitely the good EPC infrastructure funding, good EPC performance, definitely that will take care of all the economic related issues in the economy. So thank you very much, and we will take it forward for the next topic now. Thank you.
Yes, thank you, sir. At the end of the entire panel, we'll circle back and bring up some questions to you. I invite Mr. Nair now to speak, CGM at SBI, who comes to us with a tremendously privileged position because, you know, as SBI and as one of the core members of the Stressed Asset Group, they are directly involved in the resolution of hundreds of EPC companies, which are presently in insolvency. So, and as SBI does, so follows the rest of the country. So we invite Mr. Nair to shed some light on the subject. Mr. Nair, you're on mute.
Okay, sorry, apologies. So I'm not sure whether it is a very privileged position. Still sit on a pile of bad assets probably is not my idea of being very privileged. But since I will take it with a little bit of this thing. So nevertheless, I think we have, obviously, when you are in the business of banking, there will be good assets which will be created, which will eventually turn out into bad assets later on. So now we have a cross section of funding which we have done. We have a good experience, we have bad experience. Now to take out one particular sector and then to announce it to the whole world that our experience with that particular sector has been pretty bad would be pretty unfair to that sector and the people involved in that sector. So EPC, there are a lot of issues with EPC related segment, but what I can now, because after Mr. Ashok Chandra had said about the opening remarks, what I can say is a major challenge which we have observed in EPC companies are that there is absolutely zero tangible security on the ground. That's very, very critical. Then we have absolutely, second one, we have absolutely no control. Or at that point of time when all these things turn the bad assets, zero control over the cash flows, zero control over the cash flows. Then third one, huge bank guarantee liabilities, massive bank guarantee liabilities. That is, performance bank guarantee, mobilization guarantees, retention money under all hues it was given. And even for procurement of raw materials. So all these bank guarantees which were given for specific purpose were utilized by these EPC companies for actually even for buying of raw materials. That was not permitted, but it was done. Then multiple amounts are locked in arbitration. That's very painful. That's the fourth point which I see. Then resolutions outside the NCLT. If you take it to, if you look for resolutions outside the NCLT is very, very difficult actually, as promoters are not in a position to infuse equity. Then cost and time overruns. That's a major issue which these EPC companies have faced, and the challenge continues even during the resolution period. However well you structure a particular EPC resolution, all these challenges persist even beyond the initial stages. That is distressing to say the least, actually. And then fundraising is another critical aspect. Now, whether you change the promoter, you continue with the same promoter, getting funds is very, very difficult. The overall confidence which the investor community has on the EPC sector has dwindled substantially. And nobody has to be blamed for it, other than probably we have to find solutions which would eradicate this particular difficulty. So what I have said is a broader difficulties which the banks are faced in churning out the EPC companies actually. We have multiple suggestions which are there. I do not know whether all these suggestions can be told in this particular forum, but there are multiple suggestions we wanted to suggest actually. But not more importantly, major ones which I thought would be saying is that collateral security is very limited to the bankers. And that is again a major concern actually. There should be a minimum amount of collateral security which these people have to offer to the banks. And when you go to resolution, there are nothing which the bankers have. And then another one, if it is a power company, power purchase agreements has to be long term. Somehow we have seen that the power purchase agreements exist for 2 years and 3 years, but that would not be helpful. There are multiple things which have happened subsequently to enhance the position, but then long-term power purchase agreements have to be in place. And for the bank guarantees which we have issued, the margins are very, very limited actually. So those bank margins have to be enhanced a bit, but where do these people get the money for it is another point. But nevertheless, there has to be some improvement in the bank guarantees margins and all that. And monitoring of projects has never been a great priority with any of the lenders at any point of time. So ASMs have to be put in place, and a very thorough and clear monitoring of the ASMs by the ASMs is critical as we move forward. And then cash flow of the company, because at the end of the day, cash flow is what makes the company successful or otherwise. Cash flow has to be monitored very strictly. It has to be escrowed. All these things were in paper earlier, but then what has happened over a period of time, the companies also have become pretty reckless. They have opened accounts in multiple banks and completely compromised the position actually. Now that is again pretty distressing to the bankers, because at the end of the day, the project could be in some remote area. State Bank may have a branch over there, or Union Bank of India may have a branch over there. It may not have a branch also. So what do they do is that for convenience, they open in other banks, and it is chaos thereafter, complete chaos. So instead of, let us say, 5 or 6 banks funding a particular project, you will have, we have seen accounts to the extent of about 100, 150 branches of banks, various banks. So that is complete chaos as far as the cash flows are concerned, actually. So there are many such issues which we face actually, and one critical thing is that the investment in SPVs by these companies. So they launch SPVs actually for the contract to be executed on the ground, and these SPVs we have very little control over these SPVs, and the money gets diverted into those SPVs, and then there again chaos commences actually. So there are a lot of tightening which has to happen in these EPC contracting companies, and the banks have learned a bitter lesson. And probably with the lessons which we have accumulated over a period of time, we are in a better position probably now to handle the funding of EPC companies. Now, it had to come the hard way. It did come the hard way, but at the end of the day, we have moved away from recovery. We have now moved to a stage of resolutions thanks to NCLT. The importance of resolution is something which have dawned upon the bankers in a substantial way. If you go for recovery, there would be barely anything which is available. But if you have to go for resolution, then there has to be substantial equity stake which has to be put in by either by the existing promoter or a new promoter. But with the confidence which the EPC companies and EPC companies are now created in the lack of confidence which have been created by these EPC companies, there are barely anyone who comes in and puts the money. So a combined effort from the bankers, from the government, from the industry, from the people who are involved in it, that is what will take the EPC to shift gears and probably move ahead, and probably face a better time when the government launches multiple projects across the country. Over to you, Anat. You're on mute, Anat, please.
Sorry about that. Thank you, Mr. Nair. At the end of this panel, I would love to hear more from you on dividing this EPC imbroglio into two, which is one is the set of companies that are presently in insolvency, which need a unique set of solutions. And then, as you have highlighted, those which are yet to, in the next round of EPC growth that will happen, for which you have highlighted and prescribed some solutions. So there are two separate buckets of problems, and we would love to hear back when we come back to you. In the meantime, let's go to Mr. Partha Day. Partha is the head of portfolio management at perspective, not only because he's also heading the stressed assets, but because he has an experience and history in venture capital, private equity, and project finance. So, Partha, to you, please.
Thank you, Mr. Chair. It's a privilege to be, for me to be here participating in the platform. I think my co-panelists have already, kind of elucidated the macro and micro conditions. Of course, infrastructure is one of the key ingredients of any economy. It has been doing great for India, and the kind of aspirations we have, it is going to play a very important role. And we all know that there will be no infrastructure creation if there were to be no EPC companies. So that contextualizes the importance of EPC and why we are discussing what we are discussing today. So, so I would take this opportunity to maybe focus on a few aspects, highlighting what led to this stress a bit more, perhaps. Well, the macro aspect of this understanding, I think, is quite well discovered and well explored. We all know the basis of this, formation of stress has been a kind of mismatch between the asset side and the liability side of an EPC company. So on the asset side, you had slow-moving receivables, claims, and even awards, in that succeeding order, which are slow-moving. But on the liability side, on the other hand, you had liabilities which had to be serviced on a continuous basis. So this asymmetry in the timeline of how the asset side moved and how the liability side kept moving has actually, caused this entire stress. Now, the question remains, what is it that, this asset side and the liability side to begin with? Because to find a solution, we need to then go back to that question. So if we look at the asset side again, receivables, claims, and awards are something which we are all very well cognizant of. We are talking about, delays faced by EPC companies in getting payments. We are talking about disputes because of which they could not complete the milestone in time and the BG got invoked. Now, what happens is when there are delays, not only bank guarantee gets invoked, the cost implication, there's a cost implication for the EPC company, because over a period of time, the cost of their raw materials go up, the cost of overheads go up, and that impacts the profitability of that particular underlying project. And then, of course, we have the entire issue of claims, how claims are raised, how it is managed, and the time taken to do that. But of course, the silver lining is, I must quickly add, I'm speaking about the problems, I must quickly add here that fantastic work has happened already in the country in terms of addressing the claims issue, which we are all aware of, both in terms of the advanced bank guarantee for monetization of claims, and also the host of regulation, and the actual work on the ground where EPC companies are actually settling claims with the contracting agency. So that is the silver lining and good part, which I hope that will only continue to get further traction and move towards a resolution of the sector. So other than that, I would say that let me use the phrase commingling of risk here, because at the end of the day, an EPC company is actually executing a number of contracts. So what happens is, if one particular contract faces a problem, it gets delayed, that's a drag on the cash flow of that EPC company. So, in the normal course of business, what happens is that particular underlying project then relies on some other project, which is kind of doing well, where that project has, taken mobilization advance. So when such commingling happens, there is a little contagion effect that sets in. So while I had one problematic project, since I'm trying to resolve that problematic project with the other one which was going well, comes under pressure. So this is, in certain situations, we have seen that this commingling risk has actually led to further exacerbating the problem. Another dimension to this entire issue is, many of the EPC companies have also, done their, I would say downstream, integration, where they went for BOD projects. They floated SPVs, a slew of SPVs underneath the EPC company. So the EPC company morphed into both executing company, a contracting company, and a promoting company. And, as we all know, an investing company has a particular profile of liability structure. And when the underlying, that is the SPVs, they get delayed, and that is another area of discussion. We know about from EPC, there is an entire infrastructure asset sector where we are talking about project SPVs getting completed on time, converting themselves into cash generating assets. When that gets delayed, the dividends, the cash flow back into the investing company gets delayed. So, you have another dimension of, stress setting in there, which is not directly linked with your, EPC execution. So, and of course, apart from that, there are, issues of is the underlying nature of the contracts that a particular company is doing. While we, use the broad brush word of saying that, this sector is in stress, obviously different companies are in different levels of stress. So what we have seen is, companies which are focusing more on very long duration projects, they tend to probably bear the brunt a little bit more. So, so these, 4 or 5 issues, I would say have actually led to exacerbation of the stress. And perhaps, I don't know whether I'm jumping, but perhaps, one solution could be, to treat EPC not as a pooled business. So typically, EPC companies treated as a pooled business where there are multiple contracts being executed by the company, and there's no boundaries. All these are fungible. So perhaps it's time that we focus on each contract that the EPC company is executing, and that is good not only for the lenders, that is good for the company, as we just discussed, and also that is good for the contracting agency, because if they are paying on time for their particular project, there is no reason project completion of of their contract should suffer. So I think there is a need for the unit of analysis to shift from a whole, which is the entire EPC company, to a project level mechanism where we are focusing on each project, ring fencing those projects in terms of their through escrow mechanism, the cash flow trapping, and thereby generating value for all stakeholders involved, not just creditors, but the company themselves, and as I said, contracting agency. Mr. Jain, I would rest here and pass it on to you.
That's fascinating, Partha. And you were highlighting, or you were talking about one manner of addressing the issue. Of course, the other extreme of addressing the similar issue is to say that instead of addressing each project as a unit, you treat it like a portfolio and you pool all the BGs, especially because on the other side of the trade is a government in one form or the other. All the infrastructure and EPC, at least the large-scale projects, are mandated or issued by the government or the government agencies, government companies. So there may be a way to consider that other aspect, and I'll come back to you at the end of this panel to hear what you think about that, A, and also to pick up on another question you pointed out, which is that if an EPC company really exists within an adversarial regime, adversity as a function of the asset liability mismatch, as you mentioned, because if the payment gets delayed, its liabilities are still mandated on time, and the payments are a function of just a delayed environment with respect to counterparties who have that, even though they may be mandated to do it on a monthly basis, nothing ever happens on time. So there is that mismatch. So can an EPC company within an adversarial payment and an arbitration regime really achieve great success in India? We'll come back to you to hear from you. In the meantime, I go to Mr. Sampath. Ritesh Sampath is the head of the debt capital markets and project finance at HDFC Bank. Now, again, HDFC, he's been leading a range of loans for infrastructure, and he has a view on how we should be looking at doing this in the future, how we should go ahead and, how we could, he has some prescriptions for how infrastructure financing can happen and how do you address some of these problems going out into the future. So Ritesh, up to you.
Thanks, Mr. Jain. I think we at HDFC Bank are pretty lucky to have insignificant exposure to stressed assets. But having said that, it's not that we don't have exposure to EPC companies. I think we are one of the largest lenders to EPC companies in terms of the equipment finance and working capital. And that has been there historically, not just of late. Of late, obviously, we've started doing a couple of infrastructure projects, and I think if I look at the core of the EPC companies, standalone EPC companies like a services business, which does not really need too much of debt. EPC companies get mobilization advance for the project, and the mobilization advance is sufficient to generate the first bill, and post that it is a self liquidating mechanism where bills are paid and the project can continue. So typically what we have seen is a EPC company which is able to manage its working capital cycle properly, or funds its working capital largely out of equity, maybe if not even if fully, largely if it is funded out of equity, those companies are able to manage their balance sheets in a much better way. What we have also observed over the last many years is that where EPC companies have transitioned from their core services business, which is asset light, into a more asset heavy developer model. They in the course of transition, rather than raising equity to fund their various projects, they leverage their EPC balance sheets and took debt to infuse equity in those projects. Now given that we were in a there was a learning curve which was there for the entire country in terms of executing some of these projects. There are different challenges which came up, and what we've observed is that EPC companies who had funded equity, who had equity and where the equity in the SPV was funded out of equity, they were able to manage the stress in a much better way. They were able to survive because they had ability to absorb the shocks. Whereas EPC companies who took leverage on their balance sheet to fund those equity, they faced solvency issues. And had subsequently they had to go into insolvency. So this transition is something which needs to be managed in a proper way when you move from an asset light services model to an asset heavy model. And one of the core strategies around it is churning of assets, right? So EPC companies are not in the business of owning assets, and even if they have to take projects, they should churn those assets and realize the equity on a regular basis. I think from our core philosophy, promoter selection is one of the most important issue which we look at. And when you look at promoters, it is two parts. One is intent, and other is ability. Intent, obviously, whether they are able to execute. Various, all of us know what we look at when we do promoter selection. The other also important aspect is the ability to pay, execute, or pay the debt on time. From that aspect, whenever we lend to even a single project of the company, we do analyze the entire consolidated balance sheet of the companies, and that is important to assess whether there is real equity which is there on a consolidated basis, and whether on a consolidated basis the DSCR and debt EBITDA are at a manageable level. So that if there is any project which is facing any stress, we are able to assess that. When we look at the consolidated balance sheet, we look at the total outside liabilities to adjusted net worth. And when we say adjusted net worth, it is minus the investments which the company has made in SPVs, to determine whether there is any real core equity. We have seen companies where the core equity was 100 rupees and they have invested 150 rupees in their SPVs, which itself means that there is no equity left in the company to absorb any shocks. So that's the core strategy. And for us, if I have to make a grid, a good promoter, good project, good promoter, bad project, bad promoter, good project, and bad promoter, bad project. I think from our perspective, we usually are in the first bracket where we say good promoter, good project. Even if if it's a good promoter, but slightly a project which is on the edge, you can get away with it because promoter will support it. But a good project with a bad promoter, you could face different challenges. So we have that core matrix which we follow around that. The second very important thing is about the centralized project assessment. When we do centralized project assessment, we have sector experts who specialize in a particular sector, and we have internal benchmarks as to if there is a road project, typical with the typical structures, what should be the project cost for power, what should be the typical project cost, what are the various technologies which are available. And we definitely, if there is a deviation, we definitely ask those questions to the promoter. We also ensure that all the loose ends are tied up. When I say loose ends, let's say earlier we had projects where there was this LOA by Coal India that coal will be supplied. So while there was intent to supply, but Coal India didn't have the ability to supply, and which is where many projects suffered. So we when we do road projects, we assess whether on the ground whether there is adequate land available for the contractor to execute those projects. And if land is not available, we are happy to there have been instances where we have withdrawn our sanction, saying that we'll not be able to fund those projects even after doing financial closure. So we have been very, very particular about these aspects. The third aspect, which Mr. Nair rightly pointed out, is project monitoring. We have a separate project monitoring team, which is different from the people who are assessing the projects, and their role is to do site visits, interact with the authorities, go on the ground, be in touch with the lender's engineer to ensure that if there are any issues, are highlighted at the right time, so that proper action can be taken or the course can be changed if required to ensure that projects are completed on time. And the last is asset sale, which I already mentioned. We encourage our customers to churn assets with InvITs and funds coming in, and to focus on their core business model, because bloating the balance sheet beyond a point doesn't help EPC companies, because they are thinly capitalized at the end of the day. So it makes sense for them to release their equity on a regular basis and take new projects.
Great. Well, that's very useful, Ritesh. We talk about EPC companies being thinly capitalized, and my view is that EPC companies are really like banks in some way. They're a leveraged option on an entire economy, and for which reason they take a small layer of equity, expand upon it by, in this case, bank guarantees, and are able to execute a portfolio of projects at the same time. The question to you when we come back at the end of the panel is then, if you were to increase the equity requirement as you are prescribing as a solution, how do you see that affecting the ability of the Indian economy, which is thinly capitalized by equity as it is, to grow at the rate that the country seeks to? And do you see that as a constraint, the ability of both the promoters as well as the country overall to support such sort of equity-based growth? Mr. Chaturvedi is the last of our panelists. Mr. Chaturvedi is the head of loan syndication and also of international DCM, debt capital markets at Axis. He brings, again, because of his position both in India and overseas, we would love to hear from him what he has to say about the same space, particularly with regards to his experiences with the resolution of bad loans here in the country and overseas. Mr. Chaturvedi.
Thanks, Anand. So the benefit of being the last is that I could just benefit from everyone else's views, and it's a sort of validation. But the point is, when we go for the resolution and there is absence of hard collateral, right? Absence of hard collateral, very low realizable values, or sometime no resolution, but rather liquidation. My question that I would put, and then probably I'd develop a few ideas around that, is there really no value to the EPC company?
I'm sorry, I'm not able to hear Mr. Chaturvedi. Is that the same with everybody?
Yes, yes.
Professor, you are not audible.
Yes, I think he's having a bad connection. Anand, are you there? In the meantime, would any one of you want to make some comments? Yes, yes.
Okay, perfect. All right. Sorry about that. So I'm not sure until what point you could hear me. So I picked up the issue of the commingling of the risk and the preservation of the
We are losing you again. Maybe you could switch off the video.
Assess
I'm logging back. Listen, you carry on with the discussion in case my turn comes. You start with Naya. I'm running back again. Thank you.
We can't hear you.
I was wanting to make. Sure. Right. Now?
Anand, are you there? Would you like to carry forward the discussion till Mr. Chaturvedi fixes his connection?
So, I would encourage that is one we are,
I'm audible now?
Yes, please.
Okay. Sorry about that. So there was a situation the banks who have lent money very actively, rather active during the project phase, monitoring for of the project as to where the cash flows are going, how the project is running around, and taking corrective action as soon as these come to fore. I mean, if there is genuine delay in the project execution, then can we preempt a BG invocation? Because the risk that we see is in the BG invocation turning out to be the huge liabilities, and then that becomes the main part of it. So I guess that to the bankers is of extreme importance to leave it, and it becomes inevitable. And ultimately, I guess Anand touched that maybe cases it is best to go for liquidation for the company. So if we have to go for a resolution, then how open are we in our assessment to look for a solution, like for a, because there are litigation really inflated now from the litigation claims. They could be unbilled. We don't know bankers how. So are we as lenders willing to walk away, take up, go for something called a litigation financing that we can step away? I believe we have been able to do that in one of the cases right now, and it has to that extent company is able to work and to perform. take the deep discount zero coupon bonds for that particular part and agree with the litigation financier. That's number one. And yeah, and if worse comes, of course, there is one question of going for pre-packs. Now, pre-packs are yet to be taken hold in India, yet to be to put in the practical application. While pre-packs where there is a arrangement between the lenders and the borrowers. For vision. While that could work in certain cases, my sense would be just to be mindful of the moral hazard that it would trap all of us at some point of time. So this is where I would rest.
Thank you, Mr. Chaturvedi. I might just keep my screen off for a minute. There seems to be some problem at my end, but can you all hear me okay?
Yes, Anant, we can hear you.
Great, thanks. So that's a brilliant session, gentlemen. Let me just circle back now and take a common theme in here, which is that all EPC companies have almost no hard collateral, and yet they are highly leveraged vehicles. In such a situation, when a company which is facing, as I called it, an adversarial environment on account of delayed payments, on account of endlessly long arbitration proceedings, in such a situation when things go sour, what options do banks have? Given that, and I just want to correct an observation that was just made, given that liquidations of EPC companies really result in nothing. So how do banks address this terrible problem? So let's go to Mr. Nair first, and if Mr. Nair can address that, and then we can take Mr. Chandra and then others in that sequence, please. Mr. Nair.
Yeah, so that's a very interesting question. So you were saying that liquidation would not get the correct value.
Well, yes.
Then can you mute yourself, please? A lot of noise. Yeah, that's good. So you can hear me, right? All right. So liquidation per se is not bad. Now, if you have an orderly liquidation, and if you can sell the company as a going concern, you still have value in it. So liquidation per se is not a big bane for the bankers, actually. The only point is that it has to be sold as a going concern. Now, obviously, if it is sold as a going concern, there would still be a value, but that would be the last option before any bankers does actually. The other options which a banker would examine is one-time settlement. Now, the one-time settlement is something which we can enter with the current set of promoters. But the challenge to it is that, you know, the equity which these people can bring in, or the amount of money which they can bring in to settle the deal with the bankers are pretty limited. They have leveraged themselves so exponentially high that the amount of money which they hold is very, very limited. So there are some cases where we have received one-time settlement offers, but it didn't excite us considerably. So that option remains a very muted option at this point of time. And but we do explore that possibility, because continuing with the same set of people and be exiting that particular project would probably be in the best interest of both the bank as well as the country. So we do examine that in detail, and on a case-to-case basis, we take a call. There is no one size which fits all the companies. So it's taken on an individual basis actually. And then we actually do some debt restructuring. We'll try to tinker with the entire process and see whether we can structure the whole thing. You can call it restructuring. We do restructuring actually. We elongate the repayment schedules. we completely restructure the entire thing to figure out how best we can fit in all the options into that particular exposure. And a few cases we have been successful actually. So we did try that, and again, it is not common to all the companies. It's specific to individual companies, and we have been successful in that. And in some cases, we have taken it to NCLT. But what we have seen in NCLT, especially for an EPC company, is that the response to the to those companies which are in NCLT are pretty muted. The reason is that there are multiple issues which this EPC company faces. The investors are aware of it, and because of the multiple difficulties which the banks have encountered in the past and which continues to exist, and the possibility that these problems would not go away anytime soon, have actually they have the investors have actually taken a back step on that actually. So there haven't been very great response to the NCLT options actually. But as there are people who come and look for cheap assets over there, and the resolutions which we have had is not very encouraging in that sense actually. Now I'm not talking about the entire NCLT resolutions which have happened. There have been very super successful NCLT resolutions on the one side with 100% recovery. You have something which is sub 10% also, but EPC cannot and will not be in the super successful category. Pretty muted. And that major reason is the hesitancy on the part of the investors, whether domestic or otherwise, or from abroad, their experiences have not been very good. And then the ARC, some of the things have been given to ARC. A couple of power companies have gone to the ARCs actually. And the lenders have received about 15% upfront, which looks good at the current situation. And the remaining 85% have been securitized in the sense that, security receipts have been taken. So there are about 5-6 options which we have examined, and all of them have been not entirely successful, but some of them are partly successful. But if you ask me which is the best course of option for an EPC company, there is no straight answer to it. But it will be good if probably if we can work out with a one-time restructuring with the company. Over to you.
Thank you, Mr. Nair. Mr. Chandra, your views on the subject?
Thank you, Mr. Anand. I think any EPC company which under stress, I think there are only two reasons for that. One is if the promoter is good, and because of the various reasons which is beyond the control of the promoters, if the things goes wrong, I think they are in the stress. So that is one of the reasons, and there we feel that we need to support with the existing promoters. We need to work with the existing promoters, and as Mr. Nair has rightly pointed out, I think we go for the deep restructuring of those projects. Even we can go for and we are doing it also. We are doing that extra mile funding also, because most of these projects where promoter is good, and because of those various reasons the projects are delayed, the realizations from the various receivables, it is not coming. I think we need to support that, and so that the project gets completed, because at the end of the day, if the project gets completed, I think everybody will be benefited. So that is one thing which we need to do that, and we are doing it. Second aspect is that when the project is under stress, promoter has diverted the fund. Project is good, but diversion has taken place. Definitely, I think we cannot do anything with the existing promoter. The only route as of now is going to the NCLT. And what we believe, and we do that, the NCLT process, we find that all the GPC companies have the various bank guarantees for the project which is going on. So we always suggest, and we practice that also, that we go on renewing those bank guarantees till the project gets completed. And during the course of the NCLT process also, I think we should continue for the bank guarantees renewals. So that at the ultimate aim is that as long as the bank guarantees are in place, I think the project is going to continue. What we are lacking, and we believe that there is a need for having a comprehensive marketing of these EPCs to the investors. I think there all the bankers, we feel that there is a big gap is there. If the marketing properly happens, I think the lot of big investors are there in India as well as the globally also, who will pitch into that, and definitely they will invest in that EPC project. What we feel, it is a wonderful opportunities even in the stressed EPC sectors also, because most of these projects are with the government authorities. Only issue is that because of the receivables are getting delayed or some diversions has happened, I think because of those things only those stressed assets have been created. So if those investors, they pitch into that, they bring equity, they bring investment in that particular sector, I think that unit also will get revived. And we as a banker, if we are supporting the unit as long as the NCLT is going on by way of renewal of the bank guarantee, I think at the end of the day, we will be having a good resolution through that NCLT process also. I think liquidation also, Mr. Nair has pointed out, I think we see that nothing is happening, then definitely liquidation as a going concern also is a good option. We have seen that. I think good realizations have happened by way of a going concern also. See, the issue here is we need to have patience in the EPC sector. When we are doing the funding also, we need to have patience. We need to have the factor in mind that we are going to take the long-term risk in that particular sector. And as long as we have patience in that particular sector, definitely the realizations will be good. If we are account becomes stressed, account becomes NPA, and immediately we are going for the recovery, I don't think we are going to get more than 10 to 15% of our book. So I think we need to work with the promoter. If the promoter is not good, I think we need to bring in the investor and conclude the entire process. So that is my stake, and my view will be in that particular scenario. Thank you. Anand.
Hi, sorry. So one thing the panel could perhaps directionally take a view upon is let's, the companies that have already entered insolvency don't really allow for the historical promoters to participate in the resolution process. So naturally, we're talking about a shift in both in terms of ownership, in terms of capital structure, in terms of leverage ratio, in terms of the entire capital stack. Everything is going to get amended. So it may not be of any use to think about it as a moral tale of what caused the distress, but of how do we, as well, how does the country and how does the banking sector take a look at the entire wasteland of EPC companies and other manufacturing companies sitting in it, and saying that if the resolution is not happening and liquidation is the only option, then are there alternative outcomes that are possible in terms of perhaps creating debt-free vehicles which can be given to entrepreneurs or teams or investors who can then revive such vehicles? That is a subject matter of a separate conversation, but I want to go back to the panel, to Partha, in the sequence that we had. And Partha, you were to come back and give us your views on the question asked earlier.
Sure, Anand. So, let me list out a couple of aspects which would stand the EPC sector in good stead, moving forward. Because at the end of the day, we need to tackle the problem. Of course, we need resolution, and we'll move towards, having resolution both inside and outside IBC. As one of the participants had mentioned that, in one or two cases, we've had, litigation funding coming in and, out of court kind of, workouts happening. And even within IBC, there are certain outcomes that we are, reaching. But eventually, even after the resolution is done, the companies operate under an operating environment. So it's very important that what should be the characteristics of that operating environment so that this is not repeated. Now, I'll draw upon one of the points which I already mentioned earlier. I believe that it's very important to have discipline within a EPC kind of a company. The operations architecture should be such that the cash flows of each project are ring-fenced. So they don't need to set up SPVs to execute each project, but they need to have an operating architecture through cash flow mechanism, through escrow mechanism, where one were to simulate, SPVs within the existing EPC company. So what happens is, since the core issue here is, buildup of receivables and claims, not all projects being executed by a company, gets to face that situation. So when you have that kind of an operating architecture, it is easier to identify where the stress lies, and therefore easy to wield the scalpel, because you know where to direct the scalpel at. And if you can do that at a pretty advanced, at an early stage, then you are ending up handling a much smaller problem, a problem of much smaller dimension and magnitude, than letting it go on and impacting the entire operations, which is a pool of projects. So that's one, as far as the operating architecture is concerned. The second aspect, I would go back to the overarching landscape, as we mentioned earlier, that EPC at the end of the day is serving infrastructure asset creation. For a construction contract, at the end of the day, is leading to setting up of an infrastructure asset. Now, if you look at the core characteristics of an infrastructure asset, typically infrastructure assets behave on cost recovery principles. You recover your cost, you recover a reasonable return, which predominantly in most of the sectors the regulator determines, and that is it. There is not much of upside. So if the consuming party, which is the infrastructure project for the construction contractor, doesn't have upside embedded in its business model, the derivative of that, which is the EPC company's business model, naturally will not have superlative upsides. Therefore, they also work in a very tight corridor of EBITDA margins. What that means is, you do not have too many degrees of freedom to deviate from the plan or the design, or the project, chart that you drew at the commencement of the construction contract. So I would tend to believe that since we are going to set up 100 lakh crores of infrastructure, which we would, so a lot of discipline will come in terms of project preparation, where before you do the first drawdown, the CP to first close will ensure that a lot of these niggling issues which erupt at later phases of construction or development are sorted out before financial close. I think that will help in a big way to stamp out and iron out several of these issues. So this, coupled with an operating architecture where you can quarantine the problem in advance and wield the scalpel in a targeted manner, I think could probably do a lot of good to this sector and the ecosystem.
Great. A focus on strong operations is a precondition, and a strong operating environment, a strong monitoring mechanism, everything which is perhaps beyond the scope of a financial lender, but something that they can encourage and force the direction of. Ritesh?
Yeah, I mean, I think the question that you'd asked me was about equity, requirement, and if the country has to grow, how do we kind of get there? So I think government is focusing on the right direction in that, as far as that is concerned, where we are bringing in offshore capital, long-term patient capital in form of either InvITs or in form of global pension funds to come and invest in the infrastructure assets in the country.
But is it, Ritesh, may I interrupt you, but is that there for not asset creation, but at the time of construction for EPC companies? I mean, I imagine there is a lot of capital that is chasing, tolling assets and assets that are once created.
For under construction, selectively, but I would say less. I mean, under construction assets will have to be, done by the EPC contractors themselves. But there are other avenues of capital which are available to EPC contractors, whether it be in the form of IPO or, like some of the contractors are at the under construction stage entering into a forward contract with some of these funds that, once a project is completed, they will buy off those projects. What that does is that, it does release equity. Just to mention to your point about, the bank capital adequacy versus EPC, again, if you see Even when we calculate capital adequacy for banks, the investments made in the subsidiaries are deducted. Now, if you don't do that for EPC companies, what happens is that, while at the project level, you may feel that, debt equity is 30-70. If at the holding company, that 30 is also a borrowed capital, the ability of that company to absorb any kind of losses is not there, right? And, that could take down the whole, whole structure. So to that extent, it's very important to look at the adjusted net worth, whether there is actual, any equity left in the business at all to, absorb these kind of shocks. Because if there is no equity to absorb shocks, then the debt holders will have to absorb that shock, and which will lead to all the stress.
Fair enough. I think we may start, I think we're going to try and start winding down the panel, but I want to just do a couple of questions. Again, going back to two aspects. One is the number of assets, number of EPC companies that are in insolvency, and if there is any grand strategy that bankers have in the face of perhaps suboptimal outcomes that they have received so far. A, B, a very important aspect, and Ritesh, you touched upon that, others have as well, which is the absence of equity capital available for EPC companies, and then necessarily having to require a substantial amount of bank guarantees, which banks are unwilling to lend unless they are heavily collateralized with cash margins, which sometimes EPC companies don't have. So it seems to be that there needs to be an intervention to break the log jam and to take an entire asset class which is currently suffering and sometimes perhaps often neglected. And that was essentially the precondition or the suggestion for this entire conference, that this is a neglected asset class, but which suffers enormously in insolvency. I would ask Mr. Nair, who, SBI sees a lot of this. So I think the country would love to know and hear, how is it that, we're going to see this level of stress end over the next, let's say, 12, 24 months, and then a new credit cycle emerge for the EPC sector?
Okay, as long as lending happens, there's bound to be some stress. I think that is the inevitable reality of it, and we are not unduly concerned about it. Actually, at the end of the day, whether we have bankable assets which can be funded, that's what we will be seeking at all the times. So we believe that there would be some stress which would be emerging post COVID recovery. I will not be able to hazard any guess as to what would be that number, but nevertheless, there will be some number. In fact, there has been Reserve Bank of India studies which have pointed out to a bumping up of the stress asset portfolio in many banks. I will not get into the details of it, but as prudent banker, what we would be looking forward from now onwards is that with the experience which we have gathered over underwriting this particular EPC companies in the past, all the experiences will now be accumulated, and we will actually put that into the new underwriting standards which would now emerge. So we will not say that it's going to be foolproof, but at least we would have put in some mechanism to ensure that some of the past mistakes are not repeated. That is one important point which we do. The second thing is that as we progress into funding these type of companies, we would also be very, very critically evaluating the board decisions that would be taken by these EPC companies' boards. Actually, it will not be out of place to mention that there will be a significant amount of oversight which the bankers would now bring in on these decisions which are being taken at the board level. So now how it is going to happen, whether the bankers would put somebody on the board of these EPC companies and whether it would be monitored by any other mechanism is anybody's guess at this point of time. But prudence suggests that these kind of mistakes which some of the banks have committed in the past would not be repeated for good order's sake. So that oversight of the individual EPC companies' boards will nevertheless be put in place. Third thing is that what we would do is that, like in the West, you must be aware of it, covenant breach is going to be a very significant point. So we will ensure that the covenant breaches are penalized significantly. And we expect that the audited financial statements of these companies periodically bring about the covenant breaches which has happened. And all the banks will now be closely looking at those covenant breaches. And covenant breaches, if it is rectifiable, we would be happy that they would be embarking upon a system in which they will rectify that. But otherwise, penalties would come in. And that penalties would be, some of them would be significant, some of them would be moderate, but it depends upon from case to case, actually. And the fifth one would be, we would also be monitoring, as I have said earlier, there will be an ASM, all the operating matters, which is under the purview of these EPC companies would now be monitored by an ASM, and a very active ASM. It is not that if you just monitor only what the work which is going on, we would put them on a quarterly, half-yearly, yearly, budgetary basis, actually. So we will set the milestones on a quarterly, half-yearly, and a yearly basis, and the ASMs are duty bound to estimate whether these targets are achieved in a time-bound manner. And any disruption to that particular flow will be highlighted back to the banks, and that will immediately trigger some operational and financial restructuring beforehand itself. It's not that we are not going to wait for the event to occur before all these things are triggered. As Ritesh also had said earlier, it will be monitored very closely. Now, with all these things in place, and also we would be engaging with the government at various levels, whether Ministry of MORTH or Ministry of Power. There are a lot of multiple policy changes have emerged in the last 1 year or so. We would still be engaging with the government, with the Reserve Bank of India, to ensure that more policy changes are brought about, and establishments like FICCI and all that are the right set of people probably to represent the collective concerns of all the stakeholders, including the bankers, and put it before the government. And finally, the agreements which are drafted by the government departments have to be followed in its entirety. One classic example is the tripartite agreement which was entered between the telecom companies and the banks and the Department of Telecommunications, DOT. Now, basis that which the banks have funded those infrastructure assets in the telecom space, and once all these companies go belly up, you have the RComs, you have the Aircells and all that. At the end of the day, when it goes belly up, then you cite certain clauses in which you want to wriggle out of that, and talking about the spectrum matter. So those kinds of ambiguities which exist in those things have to be eliminated, and we will be taking up very strongly with the government to eliminate those possibilities. But of course, FICCI can make a significant role in ensuring that the conducive environment exists, so that the bankers gain the confidence to lend to these critical sectors, which needs the importance of which cannot be overlooked at all. So we are hopeful that things would change for the better very soon. Over to you, Mr. Jain.
That's great, Mr. Nair. I think SBI, I think it would be correct for me to say now, occupies a privileged position in being able to take thought leadership on this subject and to address this critical subject matter with the government, with the entire banking community, and take leadership. Because we have seen with respect to a couple of our own participations in the resolution process that usually the outcomes for these companies is pretty catastrophic, left unattended. And many of these outcomes are because, these companies are impossible to value. The EPC companies are often black boxes. So it's very hard. Once they go into insolvency, the value erodes almost immediately. And even in the notional value of arbitrations that may exist, or the receivables, so to speak, that may exist, those also begin to evaporate very quickly. In one of the instances where we participated, the value of arbitrations declined, down to maybe 0.5% of what they were at the beginning of the instance. So thing wide, as you of course led the charge on, is to create a new set of underwriting standards in which there is a mutual respect and understanding of the sector as well, because the sector's growth is critical to the entire country's growth. At the end of this, why don't I just leave the forum open? However, if people want to, panelists want to give a quick comment, and then we can start winding down the panel. Why don't we start with we go in the other sequence?
Sorry, I missed you.
Just
Was it
concluding
me?
comments. Sure. Mr. Parker, why don't you take this?
The same issues. Okay, sorry. Sorry, am I speaking out of turn, or should I go ahead? I think I missed you. Sorry. Okay. So I agree with every point that Mr. Nair just articulated. And that was very, very comprehensive, and we need to look at it from a comprehensive perspective. The only point I will again re-emphasize, I think Mr. Nair has also spoken about it, is and you in fact alluded to the word black box. And the reason that is happening is because of the contagion effect. It's very important to be able to have a granular, a view of the granularity of the operating of the EPC company. Then only we'll be able to pinpoint where the issue is. We should not allow issue impacting 4 projects, or eventually touch 20 other projects. I think I would put that at the core of all of these.
Yeah. It's an open forum, gentlemen. Yes.
I think over the years we have learned a lot of lessons, and definitely the regulator, the government, and the banks. I think all of us, we need to work together to have some contribution in funding and monitoring and finding the resolution in the entire process. Very rightly mentioned by Mr. Nair and other my fellow members. I think the monitoring mechanism, opening of the current account restrictions imposed by RBI, ring-fencing of the cash flows, if from the government side also, if they are in a position to contribute by of making the payment as fast as possible, and at least at the terms of reference which is there in their agreement, if the receivables come at the time of the need, I think that itself will provide a good system, and definitely the stress level which is there in the EPC sector, we will have some good contribution from the government side also. So I believe that all these 3 sectors, regulator, government, and the banks, we need to work in tandem with each other. And definitely, I think this sector will prosper. And finally, at the end of the day, the economy will prosper. Thank you.
Thank you, Mr. Chandra.
I think banks are pretty keen to fund the infrastructure space going forward. I think what is important is that government is also open to suggestions from banks. Now we have seen that we have worked very closely with the government to come out with the HAM model and TOT model, which has been pretty successful. So whatever changes to make more bankable was suggested. I think government is coming out and making those changes, and we have seen on the ground that banks are happy to fund those HAM projects and TOT projects. So I think it's an evolving environment, and the lessons that people have learned over the years are being put to use to strengthen the lending mechanism. I think end of day, banks are are holding public money, whether it be private sector or public sector banks. And we have it's like a trusteeship service where where depositors are relying on banks to make the right decisions. And if it is public money, then to that extent the engagement of all the parties, whether it be government, fellow lenders, or the concessionaires, I think it's very important that all of us play their role, so that there is equal distribution of risk and returns.
That's very well put. So I think this has been a great panel, and I want to thank each and every one of you for bringing your historical experience to this platform. Our view has been, and we have seen that Indian bankers, they work within tight constraints within the public sector and the private sector, as a regulated sector does. But they're exceptional in their ability to understand a very complex operating environment, which is very unique to India on its own, and are able to price risk, sometimes correctly, sometimes incorrectly, but be as it may, there is a positive outcome to this panel, which is that new underwriting standards will evolve for this very critical sector, A. B, all banks accept the centrality of this sector of EPC and how it is important to keep the companies going nicely, and that the companies that are in insolvency need a different mechanism and a different approach to resolution in order to avoid them being hollowing out. With this, I bring this panel to an end, and I thank all of you once again.
Anand, I could just come in with one last bit here. And so just briefly touch upon what Ritesh said about the regulatory intervention, the initiatives taken. Apart from that, one very great thing that is happening is the newer product. I mean, we are able to take out assets by way of InvITs right now in the market. There is innovation in terms of getting cross-collateralized structures out there in the market. Now, how this is taking out the stress from the developer's book or the EPC player's book. So those players who had taken this bet, gone into it, have stress cycle, are able to get off this, unlock their equity, come into it, and then they are again able to get into that. I think all these regulatory interventions are also very, very helpful at the moment. As a syndicator of the loans in the market, I can actually see a very strong market building around the InvITs out there. And of course, the HAM model has been a superb success so far. We would have done, I think collectively we've done more than 120 odd projects so far. So the road ahead is, yes, it's not going to be easy, but at the same time, it is very exciting, as because you said that strategically, it is very important for India to have very strong, large EPC companies to be able to take the nation to the next level. Over to you.
I fully, and I think very well said, sir. It is almost embarrassing that India only has one L&T. I would put it that way. I think India should have 10. There should be dozens of companies operating at the $10, $20 billion level, and there should be 50 companies at $1 billion plus. And that's how you grow a company, grow a country to a $10 trillion economy, which is all our respective ambitions. With that, I thank you all for coming. Thank you, Vicky, for organizing this. Vicky, on to you. Abba.
So, congratulations, Anand, for a very rich session today. And I must thank each one of the panelists for sharing their insights with us, taking time out for this panel and staying much beyond the committed time. Thank you so much. I'm sure the 200 odd people who have joined in to listen to your discussion would have benefited immensely today. Thank you. Have a good day.
Thank you.
Thank you.